Good evening, students. I'm C. Ankit Sharma, your income tax faculty. For today's session, I believe you must be studying very hard to achieve the goal of your life to become a CA as soon as possible. So today we will be discussing the provision of clubbing provisions. So till now, under income tax, you have gone through with the basic concept, then residential status, then 5 heads of income. We have completed all these provisions till now. And on the basis of these provision, you must have understood one thing, that under income tax, if Mr. A is earning income, then he needs to pay tax on that because it's a part of direct tax. But in this chapter, we will see some cases in which the income is going to be clubbed in some other person's income. So suppose if Mr. A is earning income, so till now, whatever we have seen that Mr. A needs to pay tax on that income. But in today's case, there might be some situations, circumstances, case scenarios in which the income of Mr. A, the actual owner of that income is Mr. A, but that income is going to be clubbed in the hands of someone else. And that someone else needs to pay tax on that income. You might be thinking how it's possible, why it is happening, why income tax doing this? This is wrong. This is injustice. No. This is due to that some person when trying to avoid tax, so to curb that provision, to capture that provision, to stop that provision, government has made prescribed provisions to stop this kind of practice, due to which tax liability is going to be reduced by assessing. So let me tell you one initially that why these provisions are in force. What was the reason? What was the logic behind it? So after understanding this example, you might be accept this that yes, this provision was the requirement of the act. So that's why these provisions of clubbing is here. So what exactly happens? Why these provisions has been introduced? You will be able to understand with the help of this small example. Suppose there is Mr. A and he is earning some income of rupees, suppose 20 lakh rupees in a year from business or salary, etc. Fine. Now he purchased a new car and he wants to let out this car for rental purpose as a taxi, etc. And due to this let out, he would be able to earn 5 lakh rupees rent in a year. So this is an additional income what he is going to generate above this 20 lakh rupees of income. So if this income is going to be added in Mr. A income, that he needs to pay tax upon it, and because its income is exceeding 10 lakh under optional tax regime and 15 lakh under default tax regime, so an approximate 30% of rate of tax is going to be applicable on this new 5 lakh rupees income. So approximate 1,50,000 would be his tax liability. Education cess surcharge could be extra. So we are just considering approximately he needs to pay extra 1,50,000 rupees tax. So now Mr. A was thinking how I can escape, how can I dodge this tax liability. So he searched a tax planning in this scenario. He saw that Mrs. A, his wife, is having nil income. She's a housewife, so she does not have any income. So Mr. A makes an agreement, a registered agreement, that whatever income I will earn from this car, that is going to be the income of Mrs. A. She will be the owner of that income. So the income of 5 lakh rupees would be of Mrs. A. And this income is going to be received in the bank account of Mrs. A also. So I have made an agreement, a written agreement, then whatever income I will earn from this car, that is going to be the income of Mrs. A. And that income is also going to be received in the bank account of Mrs. A. So if this kind of scenario happens, then what will happen? Up to 5 lakh, there would not be any tax. So if this income has been transferred in the hands of Mrs. A, so what would be the tax liability in the hands of Mrs. A? There would not be any tax liability under even optional tax regime or default tax regime. So this 1,50,000 tax liability has been dodged by Mr. A. So 5 lakh rupees income earned by him or his wife, the same thing because they are part of same family. So this could be a tax planning by which Mr. A could divert his tax liability. Suppose there is more income of Mr. A, suppose 6 lakh rupees. So he can transfer again the same income in the hands of his child or his children or to in the hands of his parents, etc. So to stop this kind of practice, to curb these kind of tax avoidance cases, clubbing provisions are there. So to stop this kind of provision, income tax said that if income is transferred, if only income is transferred without transfer of asset. So if only income has been transferred without transfer of asset under section 60, then the income is going to be clubbed in the hands of the transferor. So the provision section 60 says that if you want to transfer any income, then assets should be transferred to the same person. So if only income has been transferred without transfer of asset, then that income is going to be added back into the income of the transferor. So when I am explaining this provision, you all might be thinking, okay, we can still avoid the tax. Now we will transfer the asset also in the hands of Mrs. A. How does it matter? Now we will transfer car in the hands of Mrs. A. So automatically we can avoid this provision because this provision is going to be applicable when there is only transfer of income and not transfer of asset. So you might be thinking, okay, we can do this, that we are going to transfer asset as well in the hands of Mrs. A. So we can avoid section 60. Exactly, students. You can avoid section 60. So how many of you think that yes, via this mode, we can avoid section 60? I guess many of you must be thinking that to avoid this provision, we can still dodge the tax. We can transfer that car also in the hands of Mrs. A. So asset has been transferred and now income also has been transferred. So again, we can avoid the tax. But to stop these provision, we have multiple provisions also what we are going to discuss. There is not only section 60 is there. We have section 61, 62, 63, 64 to cover these kind of situations also. So whatever you are thinking, automatically income tax has been already knew about it. That you are going to avoid tax like this. So there are provision to stop this kind of practice also in the act. So we will discuss all these provisions. Understood why this chapter has been made? What is the reason behind it? So because we just want to transfer our tax liability, or we just want to transfer or making our tax liability minimize, to use these kind of tactics, so clubbing provision is here. So as usual, before starting the class, that was the introduction. We are going to share a thought for the day. A very inspiring personality has said something which is very, very important. You can see the future depends on what you do today. So if you want to dream about your future, that you want to achieve something, that in your future you want to earn money, reputation, good cars, etc. So that is not going to be happen until you will start making it by whatever you do today. So whatever you dreamed of, please try to work for it, and that you have to work today. So whatever you will do today, that will decide what will be your future. Okay. So let's move on to the provisions. Now we are going to discuss these provisions one by one with the help of the concept. But before starting this chapter, just a second. Okay. Okay. Good evening, Shagupta. Good evening, Chauhan. Good evening, Soumya, Rajveer. Good evening. Soumya is saying capital gain provision will be applicable. No. Capital gain provision is on transfer of asset, on profit. If we are going to transfer it for free, then okay. We will discuss all these things. Priya, good evening. Vyamari, good evening. Sunil, good evening. Tanu, good evening. Okay. So what is the exact meaning of clubbing? Clubbing is a very common word. You might be also know about this word. Clubbing means generally we go for a club for dance together, etc. So we are discussing about the income. Those are going to join together. So in this chapter, we are going to see the income that is going to be added into some other person income. As the heading suggests, you can see income of another person, income of other persons included in the assessee's total income. So practically, as you have seen in the example, that legally that income has been earned by Mrs. A. That amount of rent is going to be received in the bank account of Mrs. A. But that income is going to be clubbed for the purpose of income tax that is going to be transferred or added back into the income of transferor. Somebody has raised hand. Who has raised hand? What somebody wants to ask? Anyone was there? Okay, no one is there. So let's discuss the provision. So these are clubbing of income under income tax. So there are provisions regarding income of minor child when it's going to be clubbed, asset transfer to HUF, how it's going to be clubbed, and asset transfer to spouse, son's wife, etc. So one by one, we are going to see those circumstances in which if you transfer the income to some other person, even in that situation, that income is going to be clubbed for the purpose of income tax in your hand. Okay. Now, clubbing of income, introduction. Under the Income Tax Act 1961, an assessee is generally you are going to be taxed for the income you have earned. But this is an exception. This chapter is an exception of this kind of provision. Taxed in respect of his own income only. However, there are certain cases where an assessee has to pay tax in respect of income of another person. So before going through with the provision, I have already discussed an example with you to make you understand that income tax does not want to do this thing, but the type of situations assessee create to avoid tax, to dodge the tax, department needs to make this kind of provision. The provision for the same are contained in section 60 to 64 of the Act. These provisions have been enacted to counterattack. You can see the counteract the tendency on the part of the taxpayer to dispose of their property or transfer their income in such a way that their tax liability can be avoided or reduced. So in every situation, in every case, clubbing has been applicable only in that situation when assessee was trying to avoid his tax liability by transfer of property or by transfer of income into the hand of someone else. These provisions can be categorized as follows. Income of other person included in assessee's total income. So these sections 60 to 63 applicable on all person, whether you are individual, HUF, etc. Okay. And the second section 64, income of other person included in an individual's total income. So this is only applicable in case of individual, because when you transfer your income to your spouse, to your minor child, to your son's wife, so these kind of relation only exist in case of an individual. All other persons are artificial person. So that's why section 60 applicable on individual's income and section 60 to 63 clubbing provisions applicable on all person of category. Okay. So this is the concept, the note which explain why we need to applicable these kind of provision, because generally individuals try to avoid tax. You can go through with this note. It just explain the concept of this chapter as we discussed with the help of the example. Income of other person includable in the assessee's total income. For an example, transfer of income without transfer of an asset. So if you try to transfer only income from an asset, so only if income is transferring to someone else, but asset is still held by you. So in that case, it's a very simple provision. Income would be clubbed in the hand of a person who owned that asset. So until you transfer the asset, the income would not going to transfer in the hands of someone else. So you should transfer that asset. Then it is possible, that might be possible, that income is also going to be taxed in some other hand. But if asset is not transferring, you are still the owner of that asset, then income is automatically going to be clubbed in the hands of you, irrespective of any situation. So if any person transfer the income only, you can see what we are transferring, only income from any asset without transferring the asset itself. So as simple as that. If you own the asset, all the income accrue arise on that asset is going to be taxed in your hands. Even if you try to transfer that income legally, it's not going to happen in the hands of income tax act. Such income is to be included in the total income of the transfer. It is immaterial whether the transfer is revocable or irrevocable. So revocable means which you can reacquire. That is called revocable transfer. Irrevocable transfer means which you cannot recover, which you cannot repurchase, which you cannot reacquire. So what's the difference between these two? That is going to be discussed in next section. But for the purpose of section 60 says, whether the transfer of income is revocable or irrevocable does not matter. If you are the owner of the asset, all the income is going to be taxed in your hand. We have example. As example, we have already gone through. Mr. A confers the right to receive rent in respect of his house property. So whose house property is this? Mr. A. And the rent receive right, Mr. is going to transfer in the hands of Mrs. A. So what will happen? Even if we try to transfer the rent in the hands of Mrs. A, but income tax will tax that rent in the hands of Mr. A automatically. House property on his wife, Mrs. A, without transferring the house itself to her. In this case, the rent received by Mrs. A will be clubbed with the income of Mr. A. So you have understood why the clubbing provisions are there, because the rental income we try to transfer in the hands of his spouse, etc. Those are having no income. So they can get the benefit of basic exemption limit, etc. So Mr. A can reduce the income tax burden. But now, due to this effect, you have to transfer your asset also if you want to transfer your income. But there are some restriction conditions also exist. So section 60 is clear. Very simple it was. Mr. Watson has transferred through a duly registered document the income arising from a godown to his son without transferring the godown. In whose hand will the rental income from godown would be charged to tax? Of course, in the hands of Mr. Watson, because asset did not transfer, only income has been tried to transfer. So that income is going to be taxed in the hands of the transfer. So you can see that the rental income derived from godown shall be clubbed in the hands of Mr. Watson. Clear? Any confusion, anything you can ask? Okay, Soumya is saying clear, sir. Well done. Okay, moving on. Rajveer also saying clear. Well done. So now, income arising from transfer of revocable transfer of assets. So in section 60, there was no transfer of asset, but only transfer of income. Now, assessees try to dodge the tax by transferring asset also. But there are two kinds of asset transfer. One is revocable and one is irrevocable. So if you try to transfer your asset, so there could be two situations. Either it could be a revocable transfer, or either could it be a irrevocable transfer. Revocable transfer means that in that agreement, the agreement of transfer, whatever you have made, in that agreement, there might be any clause with that clause, there must be some power assigned to the transferor to reacquire the property after a certain time duration or on happening of some specific condition, etc. So if there is any clause in that agreement in which it has been written that that asset going to be transferred or it can be reacquired by the transfer on his birthday, or it can be reacquired by the transfer after 3 years. So if this kind of condition has been made in that agreement, so that agreement would be regarded as revocable transfer. And let me tell you, revocable transfer, if you made a revocable transfer, that does not treat it as a transfer. So if I am having an asset and if I transfer that asset to someone, and if it is a revocable transfer, then it will be assumed that still that income is going to be taxed in my end. Irrevocable transfer means if I cannot reacquire, I means the transferor cannot reacquire that asset, till the at least lifetime of transferee. So if you have mentioned that I am going to reacquire that asset after 5 years, 4 years, 3 years, then it could be a revocable transfer. But if it is in the agreement, it has been written that this asset transferor cannot reacquire till the death of transferee. Only after the death of transferee, asset can be reacquired. Then in that situation, that agreement, that transfer would be regarded as irrevocable transfer. Suppose after 3 years, transferee died. So till 3 years, there would not be any clubbing of income applicable. In revocable case, clubbing is started from first year because it will be assumed no transfer has been made. But in case of irrevocable transfer, if that kind of concept has been used, that asset cannot be reacquired till the lifetime of transferee. And suppose after 3 years, transferee passed away. Then up to 3 years, there would not be any clubbing, but from 4th year, clubbing concept would be applicable and the income is going to be taxed in the hands of transferor. So we are having the provision, this concept, the definition with example also. Just wait, we are going to discuss each and everything one by one. Mr. Anil is asking, sir, income has been transferred to his son and his son is minor. Then in that case, what is the scenario? So the provision of clubbing in case of minor child, we are having a specific provision for minor children, and you can see that how clubbing is going to be done in case of minor child. So your question, whatever you asked, is automatically going to be answered when we will discuss the provision of minor child. But for the timing, let me tell you, the income which has been earned by minor child is going to be clubbed in the hands of the parents. Only the income of minor child which is due to his skill, talent, etc. Or if it is a physical disabled child, in that case, it's not applicable. So just wait for some time, Anil. We will discuss these provision in detail. Yes, Anil, you are correct. Irrevocable transfer is actual transfer and ownership is going to change. So clubbing will be stopped. But if there is revocable transfer, then it will be assumed that there is no transfer at all. So clubbing would be applicable from inception. We are having the concept definition. Just wait till I am going to explain the section in detail. After that, most of your queries will be automatically solved. Mr. Saroj Singh, good evening. Okay. All income arising to any person by virtue of revocable transfer of asset is to be included in the total income of the transfer. So technically, revocable transfer is not a transfer. So it is assumed that there is no transfer of asset. So automatically income is going to be clubbed, like section 60 says. Now, meaning of revocable transfer. Transfer is deemed to be revocable if it contains any provision for the retransfer, that means reacquired, directly, indirectly, of the whole or any part of income or asset to the transfer. So even if you have the power to reacquire that asset, or you have the power to reacquire the income what is generating from that asset, in both cases, it will be treated as revocable transfer. So technically means if you transfer something, then you should not have any power upon it. That must be out of your power. But if you transfer something and you have power to reacquire the income from that asset, or you can reacquire the asset itself directly or indirectly. So income tax, we will not consider it as a transfer. So now the income which has been generated from that transfer from on that asset is completely going to be clubbed in your hands. It gives in any way to the transferor a right to reassume power directly, indirectly over the whole or any part of the income of the asset. Suppose Mr. A transfer a house to Mr. B and make an agreement. From this house, there would be an income of 10 lakh rupees. Rental income is going to be generated. In the transfer deed, it has been written that Mr. A can receive 20% of this income whenever he wants. So in that situation, Mr. A is only having right upon 20% of that income on the asset which has been transferred. So whether only 2 lakh rupees income is going to be clubbed in the hands of Mr. A or full 10 lakh rupees income is going to be clubbed in the hands of Mr. A. What is your answer? Only 2 lakh rupees going to be clubbed or 10 lakh rupees? Let me see. John is saying Tej Prakash, 10 lakh. Soumya is saying 10 lakh. Janvi is saying 2 lakh. Rajveer is saying 10. Priya is saying entire. Anil 10. Julie is saying 10 lakh. Well done. Dhanush is saying 10 lakh. Very well done. Very nice. And the correct answer is, of course, 10 lakh. Because the provision says it will be assumed that there is no transfer at all because it is a revocable transfer. Because the concept say whether wholly or partly. So if you have a right on wholly or partly of the income, we will assume it as a revocable transfer. And if it is a revocable transfer, then there is no transfer. And you can see the concept has been clarified, this provision. Clubbing provision will operate even if only part of income of the transferred asset had been applied for the benefit of the transferor. Once the transfer is revocable, the entire income from the transferred asset is includable in the total income of the transfer. This is very important to know that if there is a revocable transfer, then full income is going to be taxed as in the hands of transfer. If the transfer is irrevocable, Priya is asking, suppose in this example, Priya is saying if the transfer is irrevocable in the same example, then there is no going to be any clubbing concept applicable. But for that, you have to understand if the income can be used or reassumed by the transferor, it cannot be treated as irrevocable transfer. So until otherwise, you do not have any control over the income or part of the income, over the asset or part of the asset, to reacquire it, it would not be classified as irrevocable transfer. Mr. Chauhan is asking, what happened if Mr. A received 20% in cash or non-banking or no recognized mode? How income tax authority know that Mr. A earned? Mr. Tej Prakash Chauhan, I have already mentioned in the earlier class also that we are understanding the law, that if it happens, what is the provision? What practically happened, that is a different thing. So if you do not, or income tax does not know about the transaction, if you have done that in cash, in that case, there is no provision like that. In examination, you have to write if that happened, what the law says. You cannot say if income tax does not know about it, then the whole point of this chapter is gone. In practical life, maybe income tax not going to find it out, but if they found it, that is going to be your black income with huge penalty and interest. Okay, so we are not discussing how practically that's going to be happen. We are discussing provision on the basis what law says about it. Okay. Next is Ms. Priya Mishra is asking, would not 2 lakh in that case be taxable? Priya Mishra, if you are able to take 20%, that transfer would be regarded as revocable transfer. This is your wrong question. You are asking that it is an irrevocable transfer, and then you are going to take 20% out of it. So if you are able to take 20% out of it, that cannot be a irrevocable transfer. That would be a revocable transfer. In that case, 100% income would be taxable in the hands of transferor. Maybe you are trying to ask this thing, that suppose I have transferred an asset to Mr. B. I do not have any power to reacquire that asset. I do not have any power to reacquire the income. So it is an irrevocable transfer, correct? And if now suppose B willingly is giving me 2 lakh rupees, then what will happen? In that situation, there will not be any clubbing provision applicable. That 2 lakh would be treated as your depend, whether you have received that as a salary or as a business income or as a gift. So that is going to be taxed according to that provision, not as per clubbing provision. Dhanush is saying, sir, it is revocable and they have more than 50%. What does this means, Dhanush? I'm not getting your question. Sir, it is revocable and they have more than 50%. Miss P, sir, can you please give example as to how transfer can be done indirectly? Yes, why not? It's very simple. We have example, of course, in test knowledge question also. Let me tell you how indirect revocability would be there. Suppose there is Mr. A who transfer a property out of which 10 lakh rental income is going to be earned, and that has been transferred to B. Now Mr. A make a clause in this transfer deed that whatever income is going to be earned by Mr. B from that property, that 20% is not required to be received by me, but this 20% is going to be received or need to be paid to my son. So Mr. B will pay 20% to my son or my friend. So you are indirectly taking the advantage. Indirectly, you have control. So you are not taking the income to yourself, but indirectly, you have control over receiving the income, whether it is received by you or you are asking Mr. B that that percentage of income needs to be paid to be someone else. So that will also be treated as revocable transfer. Okay. Anil asking, in our earlier irrevocable transfer example, you mentioned that after some year in case transferee dies, then can transfer possible, it is irrevocable. No, you can mention that clause that till the transferee does not die, till that I will not going to take any benefit or I'm not going to reacquire that asset. Only after the death of transferee, I will reacquire that asset. So if that is a clause, then up to the death of transferee, that transfer would be regarded as irrevocable. Only after death of transferee, that would be regarded as revocable transfer. Clear? Now it is clear. Thank you for understanding. That's why we are here, Priya. Okay. Okay. Sure. Let's move on. Everything has been mentioned. Just have patience. Let me finish the provision. There are definition also. Whatever you're asking, these kind of queries also in the provision. So let me finish the concept. Then you can ask your query. Okay. Now we are having some exception. Exception where clubbing provisions are not attracted, even in case of revocable transfer. So revocable transfer means that you can reacquire that asset. That would be revocable. But now it says, if you can reacquire that asset, but if the condition of one or two satisfied, then we will assume that transfer is irrevocable. That is the same condition till the death of transferee. Section 61 will not apply. That means revocable provision would not apply to any income arising to any person if there is. So if these kind of clause is there, you can reacquire that property, but only after the death of the person for which the asset has been transferred. A transfer by way of trust. If you have transferred that asset by way of trust, which is not revocable during the lifetime of the beneficiary. So if you have transferred that asset to any trust for the benefit of someone, so till the life of that someone has not ended, till that time, if you are not able to get any benefit, we will treat it as a irrevocable transfer. So you can acquire the power, reacquire the power only after the death of transferee. In that situation, that is going to be treated as irrevocable transfer. For any other transfer which is not revocable during the lifetime of the transferee. So both things are same. This is if you are directly transfer it to Mr. B, C or D. In this case, if you transfer to a trust which is using that property or income for the benefit of Mr. B. So when B will die, you are able to reacquire that property. Or if you directly transfer it to for the benefit of Mr. D, and if D has been died, after that you are able to reacquire that property. So till the death of that person, whether it's a beneficiary or transferee, that income is not going to be clubbed. So it's very simple. Do not make it complicated. It's very simple. If there is a transfer of an asset which you cannot reacquire till the death of transferee or beneficiary, that is irrevocable transfer until that person die. No clubbing until that person die. After the death of that person, the clubbing provision would be applicable. As simple as that. Don't make it complicated. It's very simple. Clear? In the above case, the income from the transferred asset is not included in the total income of the transferor, provided the transfer derive no direct indirect benefit from such income. If the transferor received direct indirect benefit from such income, automatically it would be revocable. Such income is going to be clubbed in this total income, even though the transfer may not be revocable during the lifetime of the beneficiary or transferee, as the case may. As and when the power to revoke the transfer arises, the income arises by virtue of such transfer would be included in the total income of the transfer. You can go through the example. Dekho, Mr. Rajesh transfer his house property to a trust for the benefit of Mr. Ramesh till his death. So until Mr. Ramesh is not going to die, that transfer would be regarded as irrevocable. No clubbing. Clear? This is a situation of irrevocable transfer till the death of Mr. Ramesh. So Ramesh is a beneficiary. Hence, till then, the income from house property would be taxable in the hands of the transferee. That means the trust. However, after the death of Mr. Ramesh, now what will happen? That income of that property is going to be taxable in the hands of the transfer, because now he has the power to reacquire that property or income. Clear? So that was the provision of section 60, 61, 62, 63. Now we are discussing the income of other persons, includable in individuals' total income. This is only for individuals category. Above provision was for all assessee. Now this is only for individuals' capacity. The first provision says clubbing of income arising to spouse. Spouse means in respect of husband, we are talking about wife, and in respect of wife, we are talking about husband. Okay, so both has been included in the definition of spouse. Chauhan Tej Prakash is asking, if genuinely Mr. A makes clause that 20% go to some other person, then if Mr. A not connection with other person, it does not matter. if you have power to transfer any income into the hand of any person, whether it's connected to you or not connected to you, that means you have control over that property or that income. So if you're having any kind of control directly, indirectly, whether for your benefit or for some other stranger benefit, that would be treated as revocable transfer. Okay. So Umesh is asking, if not transferred property but transferred profit, then what will happen? So on Umesh, we have discussed this clause under section 60. The first section was regarding it. You might join this class late, so you're not getting this provision. If you did not transfer asset and only transfer income, that is always going to be clubbed in the hands of the transferor. Okay. So now clubbing of income arising to spouse, and here is a special case. Income by way of remuneration from a concern in which the individual has substantial interest. So this word substantial interest we have already gone through under, I guess, income from other provisions also. So where we discuss the substantial interest provision under income from other source concept, student, who will tell? No, Anil, I am not asking what is the meaning of substantial interest. Under which provisions of income from other source we have discussed the concept of substantial interest. Anyone remembered? Loan advance. Yes, in case of deemed dividend. Very good, Julie. Very good, Ishan. Well done. Ramesh saying, no, sir, in exception part I will ask. What are you discussing? If not transferred property but transferred profit, what does that mean? In exception part, we are discussing transferring of property. So if you are not transferring property and only transferring income, again, it will be a revocable transfer, Somesh. Same thing. Deemed dividend, Rajvi, correct. So now a different kind of example is there. Let me show you with the help of an example what kind of situation we are discussing. Suppose there is Mrs. A, who is a company secretary, and she is working in XYZ Limited. And she is having 25% equity share capital voting right of XYZ Limited. She is earning, suppose, 1 lakh rupees per month as salary income. Okay. Now, because Mrs. A is here, so there must be Mr. A also. So here is Mr. A, her husband. And he is a very good house husband. He do all the cleaning work, sweeping work, and cooking and dusting and everything. Fine. So he is a very good house husband. His income is nil. Now, company wants to appoint a person for company's cleaning purpose, for company's dusting purpose, for company's cooking purpose, etc. So company need someone to take care of company cleaning work, etc. So Mr. A applied for the job and Mr. A got the job. And his salary is, suppose, 25,000 rupees per month. So now the provision says that if one spouse working in any organization in which that spouse is having substantial interest, and in that organization, the other spouse is also start earning some income, whether salary, remuneration, commission, by whatever name called, then we have to see whether he is getting that salary due to his qualification, skill, or talent. So we have to check in this case that whether Mr. A got this job due to his talent or qualification. And qualification does not mean that you must need a degree, etc. It's not mandatory. Okay. So on the basis of fact, we have to see whether this job has been acquired by Mr. A on the basis of his talent and qualification or not. So if the job has been acquired by the other spouse on the basis of talent or qualification, in that case, there is no clubbing provision applicable. So that means this salary is going to be taxed in the hands of Mr. A only, 25,000 rupees per month. But if that has been proved, that this job has been not due to the talent and qualification, then it will be assumed that this is due to the substantial interest of the spouse in that company. So you got the job due to Mrs. A. So Mr. A got the job due to Mrs. A. So in that circumstances, clubbing provision would be applicable. And this concept, remember very carefully, because I know you are going to ask multiple questions with the same thing. So if this is not a case of spouse, suppose we have, due to the source, we have appointed our sister, brother, friend, then what will happen? No, this is only applicable in case of spouse. If that is the situation that Mrs. A, due to his substantial interest, got a job for his brother, sister, parents, etc., then clubbing concept would not going to be applicable in this situation. Only this concept in case of remuneration is going to be applicable in case of a spouse. So clubbing applicable, and what will happen? Because clubbing apply, so this 25,000 per month is going to be taxed in the hands of Mrs. So now Mrs.'s salary income would be 1 lakh per month plus salary income 25,000 rupees per month. Clubbed income is always going to be taxed in the same head of income in which it would have been taxed if there is no clubbing. So if the clubbing concept was not there, then this 25,000 is going to be taxed under Mr. A's salary head. So if any income clubbed, so there is no separate head of clubbing. Let me tell you, we are only having 5 heads of income: house property, salary, PGBP, capital gain, other source. So if the club income is going to be clubbed, then in which head that is going to be clubbed? It is going to be clubbed in the same head in which it would have been included if that income has not going to be clubbed. Suppose if it is an interest income is going to be clubbed, then interest is going to be clubbed in normal case, income from other source. So if it is interest is going to be clubbed, then in the case of that person, it's going to be clubbed. It is going to be clubbed under the income from other sources. So this is a salary. So this salary is going to be taxed under the salary head of Mrs. A. I hope it's clear. So if it is talent, etc., there is no clubbing. But if it's no talent, then it's going to be clubbed in the hands of the person who is having substantial interest. Now there could be another scenario. Now suppose there is a company, MG Limited. Now there is Mr. A is doing job in this company, as well as Mrs. A also doing job in this company. I hope it's clear. Mr. A is having 22% shareholding in MG Limited and Mrs. A is having 24% shareholding in this company. So they both have substantial interest in the company, Mr. A as well as Mrs. A. Mr. A is getting salary 2 lakh rupees per month. So total salary is 24 lakh. Mr. A other income is 10 lakh, rental income, business income, or income from other source, etc. Okay. Mrs. A salary income is suppose 25 lakh rupees. And other income is 8 lakh rupees. Now there could be 3 different situations for the same scenario as we have discussed. There could be 3 different situations. Suppose they both have talented and qualified. So if they both have talented or qualified, there is not going to be any clubbing concept. So they both will give their tax on their respective salary and other income. So there is no problem. There is no concept of clubbing applicable if they both have qualification. Suppose if one is having qualification, whether it Mrs. A or Mr. A. So this concept we have discussed in the earlier provision. In the above provision, we have discussed this concept when one is having qualification. So the person who does not have any qualification, that salary income is going to be does not qualify, does not have qualification or talent, his or her salary only. Remember, only salary income is going to be clubbed, not the other income. His or her salary is going to be clubbed in the hands of that person who is having qualification. So if both talented, we know there is no clubbing. If one is qualified, then we know this kind of scenario we have discussed in detail in above case. And the person who is not qualified, his salary only is going to be clubbed in the hand of that person who is qualified. But the new situation, what we need to discuss is the third one. Suppose they both not qualified, then how they got this job? Of course, on the basis of substantial interest, they got job. So if they both do not qualify it, then in that situation, the provision says the salary is going to be clubbed. The salary is going to be clubbed in the hands of the person who is having higher other income. Who is having higher other income. So in our example, you can see the other income of Mrs. A is 8 lakh, not including salary. Salary of Mrs. A is higher, but other income of Mr. A is higher. So in the case of that salary, and remember what is going to be clubbed only? Salary income. So in this example, if the third situation is there, then salary of Mr. A would be 24 lakh plus other income is 10, and the salary of Mrs. A is going to be also clubbed in the hands of Mr. A. And Mrs. A only going to tax for his other income, that is 8 lakh. So you might be asking that what if sir other income is also equal? There might be this kind of question, I believe. You have written both are qualified same as first. Okay, yes, it's both not qualified, correct. Not qualified, not talented, correct. Yes, so if there is no other income, or if the other income is equal, then on the basis of the given scenario, assessing officer will decide in which head income is need to be clubbed. So the concept ends over here that if there is both do not qualified or talented, in that situation, the person is having higher income. In that hand, the amount of salary is going to be clubbed. But if there is no other income or there is other income which is equal, then on the basis of fact, assessing officer will decide. Okay. These were the three situations in this case, what we are going to discuss. Ishan is asking, sir, if both do not have substantial interest, then no clubbing. Yep. If there is no substantial interest, then there would not be any clubbing. Now imagine, Ishan, in a practical way. Of course, it's a law, but in practical way, if you do not have any substantial interest and talent, then why company is going to hire you? So, but in this example, if suppose the question says that they do not have substantial interest, they do not have any talent, and they are receiving salary. In that case, clubbing provision would not be applicable. They will give tax separately. Why other income clubbed, sir? I did not club other income, Vinita. I club only salary income. Let me show you. You are confused, I guess. In this case, in the hands of Mr. A, these income is going to be clubbed. So Mr. A income would be salary income 24, Mrs. A salary income and his other income. So this is total income of Mr. A, not clubbing income. So you need to calculate the total income of Mr. A. So clubbed income is 25 only, salary of himself is 24. This other income is going to be the part of total income of Mr. A. He need to pay tax on his other income also. For the purpose of clubbing, if the question asks what income is going to be clubbed, then the answer would be only 25 lakh rupees. Priya is asking only salary income will be clubbed, not other income. Yes, of course, only salary income needs to club. No other income is going to be clubbed. So we are having that kind of scenario. The provisions are over here. You can see remuneration, cash or kind to a spouse from a concern in which individual have substantial interest. In computing the total income of any individual, in all such income which arise directly, indirectly, to the spouse of such individual by way of salary, commission, fee, or any form of remuneration, cash or kind from a concern in which individual has substantial interest. Clubbing provision would not apply where remuneration is received on amount of technical or professional qualification. We have already discussed that. What happens when both as husband and wife have substantial interest in a concern? Where both husband and wife have substantial interest in a concern and both are receipt of income by way of salary. Such income will be included in the hands of the spouse whose total income, excluding such salary income, is higher. So except that salary, whose income is higher, that person is going to be the person who is going to pay tax on the other person income. Where such income is one includes in the total income of either spouse. Suppose for assessment year 25-26, the income has been started to clubbed in the hands of Mr. A. Then in future year, it will automatically going to be clubbed in the hands of Mr. A. So we will see in the first year of this concept applicable that whose other income is higher. Once it going to be taxed in this year in the hands of Mr. A, then all future year, the salary of Mrs. A automatically going to be clubbed in the hands of Mr. A without checking the total income. Until otherwise, assessing officer wants to change it. Income arising in the succeeding year shall not be included in the total income of other spouse unless the assessing officer is satisfied after giving that spouse an opportunity of being heard that it is necessary to do so. Here's a question. Mr. A holds share carrying 25% voting power in XP Limited. Mrs. A is working as a computer software programmer in XP Limited at a salary of 30,000 per month. She is, however, not qualified for the job. The other income of Mr. A and Mrs. A are 7 and 4. Compute the GTI of Mr. A and Mrs. A for assessment year 25-26 if they are paying tax under default tax regime. So what will happen? Mrs. A's salary income is going to be clubbed in the hands of Mr. A because she was not qualified, but only salary is going to be clubbed. So you can see computation of gross total income of Mr. A, salary is 360, reduction of salary income, other income is 7 lakhs, so 9,85,000. Mrs. A only income would be 4 lakh. The question asks, will your answer be different if Mrs. A was qualified? Yes, there would not be any clubbing if Mrs. A was qualified. Okay, as simple as that, simple question. Next, Mr. B holds shares carrying 30% voting power in Y Private Limited. Mrs. B is working as accountant in Y Private Limited, getting income under the head salary computed of 344 without any qualification in accountancy. Mr. B also received 30,000 in interest on security. Mrs. B owns a house property which she has let out rent from tenant is 6,000. Compute the gross total income of Mr. B and Mrs. B. So now you can see Mrs. B is not professionally qualified for the job, so clubbing provisions shall apply due to the substantial interest in the hands of Mr. B. So salary income 3,44,000. Interest income of Mr. B's total income is 3,74,000. Mrs. B salary income, because it has been clubbed, so there would not be any salary income, but other income would be assessed in the hands of Mrs. B only, like house property income, etc. I hope it's clear. You can go through with these examples later on, and if there is any problem, of course, you can ask me later. Do not worry about it. Sir, when to club while called salary of Mr. A, while called his salary, or after called all heads of income? We have gone through with the example also, Tej Prakash. So you have seen thus income is going to be clubbed only in that head in which that would have been taxed if that would not have been clubbed. So you have seen in these example, in the salary head, you have to club that income before calculating your total income. Okay. So what the advantage of clubbing in that example number 2? Income tax want higher tax. So income tax say that if somebody is not qualified, so that means that person must having lower amount of salary income. So if we include that salary of that unqualified person into the hand of the qualified person, and if due to that clubbing, if his income increase the total amount of income, so due to the higher rate of slab, income tax can collect higher rate of taxes. Okay. Now, till now, we have seen due to different section that if you do not transfer your asset and only transfer the income, there would be clubbing. If you transfer asset and if it is a revocable transfer, there would be clubbing. In case of individuals clubbing provision, we have seen that if you provide remuneration, if your spouse is getting remuneration, salary, commission from an organization in which the other spouse is having substantial interest, then how it's going to be clubbed. Now, as we discuss section 16, and we have seen that an example, that suppose Mr. A is having 20 lakh rupees income already. He purchased a car. He transferred the income of that car, 5 lakh rupees income of that car to his wife. Because she does not have any income, so that 5 lakh is going to be non-taxable in the hands of his wife. So there would be a tax avoidance could be there. So provision has been made under section 60 that if you transfer only income and there is no transfer of asset, there would be clubbing. So now individual things that I would like to transfer my asset also in the hands of my wife. So in that situation, I still can avoid the clubbing provision. So now for stopping or to cover or to curb these kind of practice, now we are discussing these asset transfer by an individual. Same example, suppose Mr. A is having income of 20 lakh rupees. Now Mr. A purchase an asset. And from that asset, there is going to be rental income, rupees 5 lakh rupees per annum. Now, if that asset or income is going to be taxed in the hands of Mr. A, so Mr. A may be going to pay tax at the rate of 30%, and there might be a tax liability approx 1.5 lakh. Now, Mr. A knows that if I try to transfer the income of this asset to Mrs. A, only income, then section 60 would be applicable and 1.5 lakh is going to be taxed in my hand. So what Mr. A decided, let me transfer this asset to Mrs. A properly with registry. So now Mr. A going to transfer this asset into the name of Mrs. A. So now the asset is with Mrs. A, and on the income of that asset also going to be included in the heads of Mrs. A. And because of Mrs. A does not have any earlier income, so this 5 lakh could be non-taxable in the hands of Mrs. A due to the basic exemption limit, etc. So to stop this practice, income tax say yes, you can transfer this asset to your wife, but you have to fulfill one of these conditions. So if you want that this asset or the income is not going to be clubbed in the hands of transferor, then one of these conditions need to be fulfilled. The first condition, transfer with adequate consideration. Suppose if the asset value, suppose is 40 lakh rupees. Mr. A purchased this asset for 40 lakh and now he wants to, then the clubbing of income, that 5 lakh rupees clubbing would not be applicable if either Mr. A takes from his wife adequate consideration. Adequate consideration means the market value, not 4 rupees. So if the value suppose 40 lakhs, so if Mrs. A going to pay Mr. A 40 lakh rupees full consideration, then asset would be treated as Mrs. A asset and income is also going to be taxed in the hands of Mrs. A. There would not be any clubbing. So either we need adequate consideration. And let me tell you, it does not mean that Mr. A transfer 40 lakh from his bank account in the hands of Mrs. A 10 days before, and that 40 lakh rupees check Mrs. A has been transferred in the hands of Mr. A. No, that 40 lakh rupees must be earned by Mrs. A. So you have to prove that 40 lakh, whatever has been transferred by Mrs. A to Mr. A, must be earned by Mrs. A. If it is not been proved, then clubbing provision would be applicable. Clear? So we need adequate consideration. Either Mr. A needs to take adequate consideration or the second option, or take a divorce or divorce. So if Mr. A takes a divorce, then the relationship of husband and wife do not exist. So this clubbing provision is applicable in case of asset transfer to spouse. So suppose if the divorce has been taken, then there is no Mrs. A, that would be a stranger. So if you can take risk that you can take divorce and then you want to transfer your income, then it is allowed. So either take the adequate consideration or take a divorce. If any of this condition has been fulfilled, in that case, that 5 lakh rupees income is not going to be clubbed in the hands of Mr. A. Now you might be noticed it or not. In the initial example of section 60, I have written car over here. Other informations are almost same, but I have just written over here asset because there is a reason. So the concept say, if the asset transfer is a house, this asset might be a house or any other asset, car, etc. So if this asset is a house, then clubbing provision would not be applicable. Why? Because this is included, this case has been included under deemed owner definition, under section 27, income from house property. Under section 27 of house property, exactly there is a case. The situation of deemed owner has been there, which says if an associate transfer his house without consideration or without an agreement to live apart, that means divorce, to another spouse, to his spouse, in that situation, the transferor would be treated as deemed owner. So if that asset has been transferred and it is in a house, then Mr. A would be treated as deemed owner automatically under section 27, not section 64. 64 is not applicable. Mr. A would be a deemed owner, and if you become deemed owner, then automatically your rental income is taxed in your hand. There is no requirement of clubbing provision. So the implication is same. On 5 lakh rupees, you have to pay the tax. But the difference is you would be treated as the owner of that house. So that income is automatically going to be taxed in your hands. There is no requirement of clubbing provision. That is automatically is going to tax under section 27 under income from house property. We will not use the word clubbing for this 5 lakh rupees. We will classify that house property as income of Mr. A under income from house property. We will find out the GAV, then municipal taxes, and so on. If there is any other asset, then this clubbing provision, then this 5 lakh is going to be taxed under clubbing provision. So this 5 lakh is going to be taxed as per section 27 under income from house property. And if suppose this is a car or land or any other asset, in that case, that 5 lakh is going to be clubbed because you did not take adequate consideration, you did not take divorce. So that is club Mr. A. Clear? Very interesting case. Mr. Dhanush is saying that if we purchase in their name, still that would be the same case, because in that case you transfer cash into her account. So again, the property, if you transferred or you did not, Mrs. A did not pay the consideration, and due to the payment made by Mr. A, the property has been purchased. If it is a house, deemed owner concept would be applicable. If it is any other asset, then again this clubbing provision would be applicable. Clear? Mr. Tej Chauhan is asking, sir, wife giving to husband income is still in house in one. What does that mean, Tej Prakash Chauhan? Wife giving to husband income is still in house number one. I'm not getting what your question is. Mr. Dhanush, what if I gifted her? Technically, you are gifting it, Dhanush. You are giving property to your spouse without consideration. That is all what we call gift. That is the definition of gift. So that's why clubbing is there, because you are transferring it without adequate consideration. So either take adequate consideration or take divorce. Clubbing provision would not be applicable. If you did not take adequate consideration or divorce, clubbing provision would be applicable. If that is a house property, that is going to be taxed as income from house property. Otherwise, as per section 64, clubbing would be there. Moving on the provision, the concept is the same condition. Income from asset transfer to the spouse, income arising to the spouse from an asset transfer without adequate consideration. Transfer of asset other than house property, because house property provision has been separately described. Where there is a transfer of an asset other than house property directly, indirectly from one spouse to other, without adequate consideration or otherwise than in connection with an agreement to live apart, that we call divorce. Any income arising to the transferee spouse from the transfer asset, either directly or indirectly, shall be included total income of the transfer. What will happen in case of transfer of property? Section 27 would be applicable, and the transfer would be treated as deemed owner. And if you are a deemed owner, then it will be assumed that the house belongs to you, and all income of that house is going to be taxed under income from house property. No clubbing section need to be applicable. So technically, applicability is same. The income is going to be taxed under transfer head of income, but section 27 will be applicable in case of house property, and for other asset, this concept is applicable by section 64(1)(4). Now, this is very interesting and important also. Income from accretion of the transferred asset. So, Mr. A transferred a house or any asset to Mrs. A. So if rental income from that property, that is going to be clubbed. Mr. A needs to pay tax on that rental income. While actually rental income is receiving in Mrs. A bank account. But because the clubbing concept applicable, the rental income is going to be clubbed in the hands of Mr. A. Now suppose Mrs. A deposit that rental amount into bank and earn some interest income. Or suppose due to that rental income, Mrs. A purchased a new car and let out that car on rent and receiving 1 lakh rupees as rent. So these are called indirect income. The asset which has been transferred was a house. On that house, whatever rent has been received, that is only going to be clubbed. But if you earn any other income or out of that rental income, whether interest income or any other income, that is called accretion of the transferred asset. That means we can say it is an additional income on transferred asset. In that situation, that is not going to be clubbed. Only the direct income of that asset, which has been transferred without consideration, etc., is going to be clubbed. But any other income which has been generated on accretion of that transferred asset income, that is not going to be clubbed except in case of minor child. In case of minor child, even this accretion income is going to be clubbed. But in case of spouse, that is not going to be clubbed. Why in case of minor child it's going to be clubbed? That we will discuss in case of minor child concept. It may be noted that any income from accretion of the transferred asset is not to be clubbed with the income of the transferor. The income arising on transferred asset alone have to be clubbed. Alone have to be clubbed. Income earned by investing such income arising from transfer asset cannot be claimed. So this benefit is available with spouse case. Exception is minor child. Now meaning of adequate consideration, you can go through. It's a very interesting and important case. This is also very interesting and important case. Transfer asset invested in business. Now the concept says, suppose Mr. A give 5 lakh rupees to Mrs. A and Mrs. A invest these 5 lakh rupees in any business. So any profit generating from that business, a proportionate part is going to be taxed or clubbed in the hands of Mr. A. Now, how that proportion need to be calculated? So that is going to be calculated on the basis of capital investment. Suppose the net profit generated from that business by Mrs. A is 2 lakh rupees. 5 lakh Mr. A has given to Mrs. A and 10 lakh rupees Mrs. A invested herself from her income. So total capital has been in this business is 15 lakh. So we have to find out the total capital contribution in that business. So now we are receiving 2 lakh profit from this business. Then how it's going to be clubbed? The 5 lakh which has been paid by Mr. A out of that 15 lakh, the proportionate 5 lakh rupees profit generation is going to be clubbed in the hands of Mr. A. So if transferred your investment in the business and if any amount has been received from your spouse, so the proportionate amount of capital which has been invested, the amount of proportion belongs to the spouse from whom you have received the amount for the purpose of investment is going to be clubbed in the hands of that spouse. But the very, very important thing, please remember this. The capital contribution proportion need to be checked on the very first day of previous year. So our examination previous year is 24-25. So we are talking about 1st April 2024. So if Mr. A gave this 5 lakh rupees before 1st April 2024 on 1st April 2024, then the income is going to be clubbed. But suppose Mr. A gave this 5 lakh rupees to Mrs. A on 2nd April 2020. And for this year, she earned 2 lakh rupees profit. In that situation, there would not be any clubbing. So clubbing would be possible on the basis of capital contribution as on 1st day of the previous year. So you have to be very careful in the examination or in the question to check it out, the contribution date, if it is on or after 2nd April. So that year there would not be any clubbing. So where the asset transferred directly, indirectly by an individual to his spouse are invested by the transferee in the business. Proportionate income arising to the transferee from such investment is to be included in the total income of transferor. If the investment in the nature of contribution of capital, proportionate interest receivable by the transferee from the firm will be clubbed with the income of the transfer. Same concept is applicable. Now the most important thing, such proportion has to be computed by taking into account the value of the investment as on the 1st day of the previous year to the total investment. Okay, so you have to remember this very carefully. This is the example. This is your homework. Solution is also there. Go through with the question, solution, and if there is any query, you can ask me, of course. Transfer of asset for the benefit of spouse. So we have seen that if you transfer the asset for the benefit of a spouse without consideration or without divorce, the clubbing provision is there. But now if you transfer that asset for the indirect benefit of a spouse, then again clubbing provision would be there. Suppose Mr. A transferred a house to Mr. B without consideration. And there's a condition is there that whatever income of this property would be there, that income is going to be transferred by Mr. B to Mrs. A. So technically, this income is indirectly flow. You did not transfer the asset directly to Mrs. A, but you indirectly make the benefit. You transfer that asset to Mr. B, and you have made a clause that the benefit of that asset needs to be transferred to Mrs. A. So again, in that case, clubbing provision would be there. All income arising directly, indirectly to any person, association from the asset transferred, directly, indirectly to such person or association of person by an individual, without adequate consideration is includable in the income of the individual to the extent such income is used by the transferee for the immediate or deferred benefit of the transfer spouse. Clear? Now, a very good provisions, or you can say a very easy concept, and that is clubbing of income arising to son's wife. So we have gone through with the provision of asset transfer to wife. Almost same provisions are applicable in case of son's wife. Exactly almost same with very minute differences. So income arising to spouse concept we have discussed. Now income arising to son's wife from the asset transfer without adequate consideration by the father-in-law or mother-in-law, section 64(1)(6). The first case was in case of transfer asset to spouse was like this. Suppose there is Mr. A who transfer a house to Mrs. A without adequate consideration, without a divorce. Then the income is going to be clubbed in the hands of Mr. A. The same concept is now over here, only the condition has been reduced. Suppose Mr. A transfer a house to his son's wife only first condition would be applicable without adequate consideration. And the good thing, section 27 is not applicable. In case of a spouse, if that is a house property, income from other source applicable. Other asset, section 64 applicable. But in case of son's wife, whatever asset you transfer to your son's wife without adequate consideration, clubbing provision would be applicable. So any income earned by son's wife from any asset which has been transferred by her mother-in-law or father-in-law without adequate consideration is going to be clubbed in the hands of transfer. Very simple. Same concept as in case of wife. So where an asset is transferred directly indirectly by an individual to his or her son's wife without adequate consideration, the income from such asset is need to be included in the total income of transfer. Same that business concept is applicable copy paste. In the case you provide amount as a capital contribution to your son's wife and she invested that in the business. Same provision copy paste is here. On the first day of the previous year, we have to check it out. And then the proportionate amount is going to be taxed. The next provision also same. If you transfer the asset for the benefit of son's wife as directly, indirectly concept, then again, in that situation, the income arise directly, indirectly for the benefit of son's wife is going to be clubbed in the hands of transfer. This illustration number 6 is your homework, students. Now the clubbing of minor child is there, but before that, of course, let me take your queries and then we will go for a short break. Anil asking, sir, in case of transfer of house, simultaneous divorce clubbing provision still applies for house property, right? As under section 27, we have to, there is no simultaneously. If the date of transfer is before divorce, in that case, clubbing would be applicable. But the day divorce has been announced or has been done officially, after that, any income which has been arise to the spouse, which is now a stranger, is not going to be clubbed. Suppose on 1st April, asset has been transferred, the 5 lakh rupees is the rental income. And from suppose 1st of July, divorce has been taken. So from April, May, and June, 3 months clubbing provision would be applicable. From 1st July onwards, the income is going to be clubbed in the transferee hand. Okay. Johan Tej Prakash is saying, if no clause, then clubbing. If there is no clause for the benefit of son's wife or spouse, direct or indirect, then in that case, there would not be any clubbing provision applicable. Okay, Mr. Tej Chauhan. So the minor concept is left. So we will discuss that concept after a short break. We are having minor concept and a cross transfer cases. So after these two concepts, we will continue. So Mr. Manish, can we have a short break? 5 minutes break today will be there. Okay, welcome back everyone. So Kevin is asking, sir, what if entire capital is given by Mr. A, or that 15 lakh is transferred to wife account from Mrs. A account and then transfer for business and earn, how is going to be taxable? Your question is confusing because you are saying that 15 lakh is transferred to wife's account from Mrs. A account. The same thing you are repeating. I guess your question is something different. Maybe you try to ask or you want to know that if we transfer from our account to to its wife account and then wife use it for investment purpose. So let me tell you, if that has been proved that the investment amount is not earned by Mrs. A or the wife, and it has been indirectly provided by her husband, in that case, clubbing provision would be applicable. Okay. Rajveer is asking, all the clubbed income will be included in salary? In which case you are asking, Rajveer? In which concept you are asking that all the income will be included in the salary head? I have already told you. It will depend on the nature of income. If the nature of income which is going to be clubbed is salary income, then it is going to be clubbed under the salary head of income. If the nature is business, that is going to be clubbed in business head of income. Okay. So moving on further. In case of minor child. So in case of minor child, there is very easy concept. All incomes of minor child is going to be clubbed. A very straight provision. All incomes of minor child, all incomes of minor child is going to be clubbed. Except there are few exceptions also. If that is earned by minor from his skill, talent, physical work, etc. Suppose the minor child is working in TV serials or advertisements or movies. So that is called his skill income. That is not going to be clubbed. That would be treated as the minor income. Suppose that minor is playing some sports, and if he or she is earning from that sport activity, that is not going to be clubbed. First thing. Second, if minor is suffering from physical disability, as defined under section 80U, etc. So if that minor is suffering from any physical disability, in that case, no income is going to be clubbed. Whether that is from his skill, talent, physical work, otherwise, etc., does not matter. So if minor is earning any income from skill, talent, etc., in case of a normal child, that is not going to be clubbed. But if it is a disabled child, in that case, whether income is from skill, talent, not talent, or any other kind of income, then clubbing does not applicable. I hope it's clear. In case of minor child, there is an exemption of 1,500 rupees per minor child, which can be claimed by the parents. 1,500 rupees per minor child, or income clubbed, whichever is lower. Lower can be claimed as deduction, but it is applicable only if you opt out from section 115 BAC, opt out. So if you fall under default tax regime, you cannot claim this exemption. That is not per month, that is annually 1,500 rupees or income clubbed, whichever is lower. And if you fall under default tax regime, then you cannot claim this deduction. So these are the basic provision regarding clubbing in case of minor child. Let's discuss the detailed provision. Clubbing of income of a minor child under section 64 1A. And you can see all incomes of a minor is to be clubbed in the income of his or her parent. Now, in whose hand the income is going to be clubbed, whether in the hands of mother or whether in the hands of father. So who will have higher income? In that person, the minor income is going to be clubbed. Who is having higher income? Other than that minor income, who is having higher total income? In that situation, that minor income is going to be clubbed in that parent. However, now the exception. So these income would not be clubbed. Income deriving by minor from manual work, that means physical work, or from any activity involving his skill, talent or special knowledge or experience will not be included in the total income of his parent. The income of the minor will be included in the income of that parent whose total income, excluding minor income, is greater. Once clubbing of minor income is done with that of one parent, then in every year, the minor income is going to be clubbed in that parent only, until otherwise, assessing officer thinks that we should change and we should tax that minor income in the other parent income. If there is divorce, where the marriage of the parent does not subsist, in that case, minor income is going to be clubbed in the hands of that parent who maintain the minor child in the relevant previous year. So you have seen that there was an exception of skill, talent, etc., and there was an exception of disabled child. However, the income of a minor child suffering from any disability, as specified in section 80U, shall not be included in the hands of the parent, but shall be assessed in the hands of the child. So if there is a disabled child, then any kind of income, whether via skill, talent, or not a skill, any kind of income is not going to be clubbed. So very straightforward, very simple provision in respect of a minor child. It may be noted that clubbing provision are attracted even in respect of income of minor married daughter. Why specifically it has been written minor married daughter over here? Did you ever go on any provision regarding minor married daughter in earlier chapters? You have gone through with this concept of minor married daughter in income from house property. Under income from house property, there is a section which is section 27. Again, the deemed owner. And in case of that provision, the concept say that suppose Mr. A transfer a house property to any of his minor child without adequate consideration, then Mr. A would be treated as deemed owner under section 27. And income of that property automatically going to be taxed in the hands of Mr. A, except in case of minor married daughter. Now, there's a very interesting thing. Let me tell you. Look, section 27 says that suppose there is Mr. A who transfer his house property to minor child without adequate consideration. In that case, Mr. A would be treated as deemed owner. Suppose the rent is 5 lakh rupees. So A would be treated as deemed owner. And this rent is going to be taxed under income from house property. No clubbing provision is applicable. There is no clubbing required because Mr. A would be treated as the owner of that house. But the provision says except in case of minor married daughter. So if there is a minor married daughter, if Mr. A transferred that property to minor married daughter, in that case, minor married daughter would be treated as owner. Section 27 does not applicable. No deemed owner of Mr. A. So she will be treated as the owner of that property. So what will happen? The rental income but is going to be clubbed in the hands of still Mr. A. So she will be the owner of that property. In case of other minor child, Mr. A would be deemed owner. So automatically 5 lakh is going to be taxed as Mr. A income. But in case of minor married daughter, she would become the owner of that property, but it does not mean that she needs to pay tax. The income of 5 lakh is going to be taxed automatically, but under section 64(1)(a). So again, as same in case of a spouse, In case of house property, section change. It's not 27. In case of 27 applicable, other assets section 64 applicable. In case of minor married daughter, if the house property has been transferred, if any other asset has been transferred, then clubbing provision. In case of house, Mr. A would be deemed owner, but in case of minor married daughter, the daughter would be the owner, but still the income is going to be clubbed in the hands of parents. So more or less, the taxability would be in the hands of parent. There's the exemption under section 1032 as we discussed, 1500 rupees. In case the income of an individual includes the income of his minor child in terms of section 64(1)(a), 1500 rupees in respect of each minor child you can claim, or up to the amount of income, whichever is lower. But this will be available if you opting shifting out of the default tax regime. Now here is the minor married daughter special case as we discussed. In case of asset transfer to a minor child not being a minor married daughter without consideration, section 27(1) would be applicable, and automatically the transferor parent would be the deemed owner. So the income is automatically going to be taxed in the hands of that parent, and section 64(a) would not applicable because as a deemed owner, the income is going to be taxed. So even you cannot claim the exemption of section 1032, 1500 rupees per month, because you became the deemed owner. 27 applicable, not section 64(1)(a) applicable. So in this case, section 1032 exemption not applicable. But in case of minor married daughter, because clubbing provision applicable, so you can claim section 1032 exemption if you are opting out from the default tax regime. However, if the house property is transferred by a parent to her minor married daughter without consideration, then 27(1) is not attracted. In that case, 64(1)(a) will be applicable, and income is going to be clubbed in the hands of that parent who is having higher income, and that parent can claim the exemption under section 1032 if they decide to opting out from section 115 BAC. This illustration is for homework, students. One more illustration, number 8. I will upload a MCQ sheet also. 6 question MCQ sheets for clubbing concept. You should download it and please go through with those questions also. Those are also kind of a homework, and we will discuss all these questions in our next session. Now there is an interesting concept of cross transfer. Cross transfer. So when government makes law or provision, people try to dodge them. People try to avoid them. So to stop that avoidance, government needs to make new concept, the new provision. And this is a very interesting example of that kind of dodging. To stop that kind of dodging, income tax need to introduce cross transfer provision. So you must be thinking that all clubbing concept has been discussed and government has actually stopped all kind of this tax avoidance due to transfer of asset or money. But it's not that. People always try to find out the new avoidance regime, new avoidance techniques, etc. So suppose there is Mr. A who wants to transfer 10 lakh rupees to Mrs. A to purchase a house. Now problem is that if Mr. A transferred 10 lakh rupees to Mrs. A to purchase a house, then this house, of course, income is going to be clubbed in the hands of Mr. A via deemed owner concept or any. There is Mr. B also who wants to give 10 lakh rupees to his wife to purchase a car and wants to let out that car. This is our car. Again, the same problem. If Mr. B transferred that 10 lakh rupees into the account of Mrs. B and she purchased that car, then again the rental value is going to be clubbed in the hands of Mr. B. So to avoid this kind of concept, because this concept is applicable in case of spouse only, spouse included, minor child included, and son's wife. If you transfer the asset in three category of person, then clubbing concept would be applicable in case of individual. So Mr. A transferred 10 lakh rupees to Mrs. B, and Mr. B transferred 10 lakh rupees to Mrs. A. So now if Mrs. B purchase a car from the amount received from Mr. A, who is not in the definition of spouse or minor child or son's wife, so clubbing section 64 is not going to applicate. And the same way, if Mr. B paid 10 lakh rupees to Mrs. A and she purchased the property, in that situation, clubbing provision would not be applicable. And if any rental income is there, suppose 5 lakh, etc., that is going to be taxed in the hands of Mrs. A. Why? Because Mr. A already having 20 lakh rupees income. Mr. B is already having 30 lakh rupees income. From the car let out, 4 lakh rupees rental income would be there. So to avoid this kind of clubbing concept, which has been included in earlier provision, a new concept has been, innovative concept has been derived by these people. So now this is called cross transfer. So if we transfer the asset or money to circumvent the law, the word is very interesting, circumvent the law. Circumvent means to dodging the law. But the main intention is to avoid tax, to dodge the provision of clubbing. And if the government finds it out, do not ask me how income tax will come to know, how they will find it out, it happens, because that is a practical situation. We are talking about what the law says. So, if it has been proved that these transfer is just to avoid the taxability of the income, to dodge the law, so clubbing provision would be applicable, and it will be presumed that the income earned on that property is going to be clubbed in the hands of Mr. A. Whatever rent is going to be purchased, going to be taxed under Mr. A, and this rental income is going to be taxed in the hands of Mr. B. So that will be presumed that indirectly the spouse is transferring the income to the other spouse for the purchase of these assets. So we have to see as per the actual cases. On the basis of fact, government needs to decide whether it is a genuine case of cross transfer or not. We have the specific provision for that. In the case of cross transfer also, it's A making gift of 50,000 to the wife of his brother B for the purchase of a house by her, and simultaneously gift by B to A's minor son of shares in a foreign company worth rupees 50,000 owned by him. So technically these gifts will cross between only those three categories: spouse, son's wife, and minor child. So I am giving amount to someone's spouse, and maybe he's transferring to my spouse or my son's wife or my minor child. In that case, this cross transfer will applicable. The income from the asset transfer would be assessed in the hands of the deemed transferor. So even the amount has been paid by B to Mrs. A, but it will assume that Mr. A has been paid that amount to Mrs. A. If the transfer are so intimately connected as to form part of a single transaction, and each transfer constitute consideration for the other. So practically it is not easy to identify, but we are reading the law that what will happen if the situation is this. Okay. Soumya is asking, sir, how minor can get married as per law? There are some circumstances in case minor marriage is valid. You can Google it. There are some circumstances, some castes are there in specific situation. Even High Court has been approved in some specific situation, the marriage of minor daughters. You can go through, you can Google it, you will find out these cases. Okay, Mr. Shiv Chaudhary. Dhanush is asking, sir, can you explain again? You are on YouTube, you can scroll back and you can see I am explaining it again and again. Yeah, same amount should be there. If there's a less amount, then clubbing would be applicable on proportionate amount. That concept also is here. Don't worry. Thus, in an instant case, the transfers have been made by A and B to persons who are not their spouse or minor child, so as to circumvent the provision. This is very interesting word. Circumvent means to dodge the provision of this section, showing that such transfer constitute consideration for each other. A case law, I would recommend you to please remember this case law, and if in the examination cross transfer is here, so please mention this case law, it's very important. The Supreme Court, our apex court, in case of CIT versus Keshav G. Morarji, observe that if two transactions are interconnected and parts of the same transaction in such a way that it can be said that the circuitous method, circuitous means राउंड एंड राउंड एंड राउंड एंड राउंड, हिंदी में कहते हैं चक्कर चक्कर, इस तरह से, लाइक circumventing, okay, in a loop, had been created in a loop. Circuitous method was adopted as a device to evade tax. This need to be proved that these transactions just to evade the tax, the implication of clubbing provision would be attracted. Accordingly, the income arising to Mrs. B from house property is going to be taxed in the hands of B, and the income arising to the minor son A is going to be taxed in the hands of A, assuming that actually they have transferred the money to their spouse and minor child. This is your homework, students. That was the case of cross transfer. Now, conversion of self-acquired property into the property of a Hindu undivided family. So if any individual, a member of an HUF, if transfer his property without consideration to a HUF, in that case, whatever income has been arisen on that asset is going to be clubbed in the hands of that individual. Special provision has been made. Section 64(2) deals with the case of conversion of self-acquired property into the property of a Hindu undivided family, where an individual who is a member of a HUF converts at any time after 31st December 1969. So before that date, there was no concept, there was no applicability of clubbing provision on these kind of activity, but after that, now this provision has been made. His individual property into the property of the HUF on which he is a member, or throw such property into the common stock of the family or otherwise transfer such individual property directly, indirectly to the family, otherwise then for adequate consideration. The income from such property shall continue to be included in the total income of the individual. Now, two situations has been covered under this concept. It says, suppose there is Mr. A. He is having a house property in his own name. He transferred this property into the name of HUF. Why? The same criteria. Suppose Mr. A is already having 20 lakh rupees. Now he is having a house. The 5 lakh rupees is rental income. So what he did, he transferred, donate, give this property to HUF. HUF does not having any income, so up to 5 lakh, there would not be any tax. Or yes, there would be tax or no, up to 5 lakh. There would be tax because up to 2.5 lakh, that would be exempted under default tax, optional tax regime, and HUF cannot claim rebate. So there would be lesser tax, around about 12,500. But if that 5 lakh is going to be taxed in the hands of Mr. A, then there would be 30% tax, 1.5 lakh rupees could be there. So to avoid this thing, Mr. A transferred that property into HUF. So to stop that concept, section 64(2) applied. That if any member of an HUF transfer any property to its HUF without consideration, then clubbing provision would be there. This would be clubbed income in the hands of Mr. A. The first case. Now the second case said that suppose now the partition take place. Under HUF, partition takes place, whether it's a partial partition, under section, I guess, 171, I'm not sure, partial partition or total partition. The section of partition, let me tell you, partition, I guess it's 170. partition. HF. 271, I guess. Yes. Section 171. Okay, clear. So if there is a partition, and in that partition, this property what Mr. A has been transferred to the HUF has been divided into 4 members. Suppose there were 4 members. 1 by 4, 1 by 4, 1 by 4, and 1 by 4. Mr. A, Mrs. A, suppose Mr. B or Mrs. B. Then the amount of income which, and suppose this property is earning 4 lakh rupees rental income. So the amount of income which has been received by Mrs. A on the partition is also going to be clubbed in the hands of Mr. A. So there is 2 concepts in case of HUF. If you transfer your property to HUF, then whatever amount of income has been earned by HUF is going to be clubbed in your end, full income. But if partition take place, then whatever share you will get, that is going to be taxed in your end, the income proportionate to that share. And whatever amount of share your wife receives, still that share of income is going to be clubbed in the hands of the transfer. These 2 concepts are here. First we have discussed. Now the second case, where the converted property has been partitioned either by way of total or partial partition. The income derived from such converted property as is received by the spouse on partition will be deemed to arise to the spouse from asset transferred indirectly by the individual to the spouse, and consequently such income shall also be included in the total income of the individual who effected the conversion of such property. Yes, Tej Prakash, 1 lakh of Mr. A, of course, rental part, and the wife income of that property is also going to be clubbed. So technically it would be 2 lakh. So in case of Mr. A's Karta, it will not affect the provision. Whether if it is Karta or not, the concept would be remain the same. Where income from the converted property is included in the total income of an individual under section 64(2), it will be excluded from the total income of the family, or as the case may be, of the spouse of the individual. Obvious, the language is different, but what it suggests. In first case, suppose the HUF 5 lakh income from this, and suppose HUF also having 3 lakh rupees separate income. So it's a normal provision that if that income is going to be clubbed in the hands of Mr. A, then on that part of income, HUF does not need to pay tax. So HUF will only pay tax on 3 lakh rupees on its own income. This 3 lakh is not from this property. From this property, income was 5 lakh. This was other income which has been earned by this HUF from business or anything. So whatever income is going to be clubbed in the hands of some other person, that income is automatically excluded from the person in which head it would have been received. In the same case, if 1 lakh has been received by Mrs. A, and this 1 lakh is going to be clubbed in the hands of Mr. A, then Mrs. A needs not to pay tax on this 1 lakh rupees income. That income would not part of its GTI. That we already have seen in the examples. That remuneration example, when salary received by the spouse, when other spouse having substantial interest. So if that salary income is going to be clubbed in other spouse income, then that salary income is not going to be taxed in your hand because it's already included in someone other income. In case is Mr. B, Mrs. B income club. No. Mr. A and Mrs. B receiving that income due to HUF. So they did not receive that income from their spouse or from someone else. So they are receiving this income from HUF, and HUF is transferring that property income in the hands of Mr. B and Mrs. B. So clubbing provision would not applicable. Clubbing provision applicable when the property has been transferred by yourself. So Mr. B did not transfer that property. Mrs. B did not transfer that property. So whatever ratio of income they will receive, that would be taxed in their hand. There is no inclusion of that income in case of Mr. B or Mrs. B. Okay, Soumya, same question. Now, of course, a very simple question. Income include loss or not? The answer is yes. So as the income is going to be clubbed in the hands of a special category of person, we have gone through with the provision. If there are any loss generated, that loss would also form part of the person who is the transfer of that property. So as well as income, as well as the loss need to be carry forward. Like suppose Mr. A transferred a house to Mrs. A without consideration. And this is self-occupied property, and interest paid on this house, suppose 2 lakh rupees. No other income, so 2 lakh would be the loss. So now this loss is going to be the part of Mr. A income. Mr. A can use this loss for set off purpose also. How that set off is going to be done, that we will discuss in next session. That is the next chapter, set off of losses. So the point number 6 explain that as per the explanation 2 to section 64, income would include loss also. Accordingly, where the specified income to be included in the total income of the individual is a loss, such loss will be taken into account while computing the total income of the individual. It is significant to note that this explanation applies to clubbing provision under both section 64.1 and 64.2. Now, what was the distinction between section 61 and 64? In the starting, I have explained you that section 61 is for all assessees. And this is for individuals. It may be noted that the main distinction between the two sections is that section 61 applies only to a revocable transfer made by any person, while section 64 applies to revocable as well as irrevocable transfer made only by individuals, in which 3 categories has been decided: spouse, son's wife, and minor child. Clubbing provision are attracted. There was a very interesting point, that was accretion of income. And I've explained to you that if there is any income earned by clubbing income investing somewhere, then that is not going to be clubbed in case of a spouse or son's wife. But in case of minor child, that is also going to be clubbed. Clubbing provision are attracted in respect of income arising from asset transfer. However, income arising on accretion of income arising from transfer asset would not be clubbed except in case of minor child. Let me explain you how. Suppose there is Mr. A. He purchased a car. Out of this car, 5 lakh is going to be the rental income every year. Now this car has been transferred to, suppose in case 1, Mrs. A, of course, without consideration, and of course without divorce. Suppose minor child B. Mrs. A, the income of 5 lakh is going to be clubbed in the hands of Mr. A in both cases. Clear? Now Mrs. A invest this 5 lakh rupees, suppose in any bank FDR, any business, any shares, etc. And out of these investment, if there is any interest income, profit generate, capital gain, these not going to be clubbed, no clubbing. And if suppose the same case done by Mr. Minor B, 5 lakh, if he invested for bank FDR or share purchase, etc., then on this income also clubbing provision applicable. I hope it's clear now. Vinitha is asking, which person pays, sir? Which person pays, sir? In which context you are asking, Vinitha, this question? Please explain me in detail your query, so I will answer that. Okay. Example, you can see Mr. X transferred debentures of 50,000 carrying 10% per annum interest to his wife. The interest income of 5,000 would be clubbed in the hands of Mr. X. However, in case his wife deposit 5,000 in FDR, 8% per annum, then interest is not going to be clubbed. But if this is not wife, if this is suppose minor child, then this FDR income of 400 is also going to be clubbed. Okay. These are revision part. So for your homework, test your knowledge question, also part of your homework. Kindly solve all these questions or test your knowledge. Question 1, 2, 3, 4, 5. We are having the solution of all illustration and test your knowledge questions. So if there's any query, I am going to solve it for you in the next session. Okay, can you tell me one thing? I want to ask a very interesting question to all of you. Listen very carefully. Have you noticed that clubbing provision in case of individual? In case of individual, if you transfer asset, only clubbing provision applicable in case of spouse and son's wife and minor child. Only. Why not other relation has been included, like parents? If you transfer your property without consideration to parents, there would not be any clubbing. Not in case of even sons. Son's wife has been included, but not son. If it is minor, then the other thing, but suppose son's wife has been included. So if you transfer asset without consideration to son's wife, that has been included. But son has not been included. Brothers, sisters, parents has not been included. Grandparents does not include in the category. If any individual, let me tell you, transfer any asset except these 3 persons, any friend, brother, sister, son, daughter, they are not minor, of course, parents, even without consideration, then no clubbing. The income on that asset is going to be taxed in their respective ends, not in the case of in this individual. So why only these 3 categories of relation has been selected? What is the special things you think you can find it out in these 3 relation? That's why they have been included for the purpose of clubbing only. Okay, Vinitha is asking which person tax pay in case HUF. HUF is itself a person. HUF itself a person, so HUF will pay tax. On club part of income, the individual is going to pay tax, but whatever is the other income on which HUF is fall in the category of a person, like a partnership firm, like a company. So HUF is going to pay tax on that part of income which belongs to HUF. Sunil Kumar is saying blood relation. Spouse के साथ blood relation कब होता है हमारा? Husband wife is having blood relation. Son's wife is having blood relation with mother-in-law or father-in-law. Son do not have our blood relation. Okay. Tej Prakash saying because this have not more income commonly like spouse, housewife, etc. No, not The correct answer, parents does not having generally the higher income. After 60 years, mostly parents do not work. Your mother do not work generally. Why mother does not include? If you're thinking that these person do not have income, then mother, grandmother, grandfather must be in the definition. Unless saying, sir, in this case, the chance of tax diversion because the spouse might not work. What about mother, Mr. Anil? And how about grandmother? Harshada, in case of other relation, they are independently earning income. Mother is also earning income and grandmother also earning income. Really? Rajveer is saying dependence. Son's wife is depending. Son's wife is dependent upon us. Son is not depending upon us. Son's wife is depending. How it's possible? How son's wife is depending upon us, but not son? Son's wife must be depending upon her husband, not upon us. Miss Tanu Vishwakarma is saying because may they think in case of women there is no tax. How about mother, grandmother, sister? Why they did not include it? So it's a very interesting question. Sir, you only say the answer. Okay, maybe due to divorce provision. Son's wife के साथ कौन सा divorce और minor child के साथ कौन सा divorce provision? And let me tell you, of course, it's not a question of your syllabus, and this is a question of logic. Generally, I do not ask you this kind of question, but because it's a very interesting answer, so the logic behind it, it has not mentioned in the law anywhere. Let me tell you, it's just a logic what I personally think. Why it is there? Because generally it has been considered that these are in our control. So these provisions are very old. Do not think about it as son's wives, how they are in our control. So it's not the current provision we are talking. We are thinking about the old situation. Act is 1961. These provisions are like 1970 or 80 kind of. So at that point of time, it was a tendency that might be spouse, son's wife, and minor child. They are under control of this individual. Generally, the control could be a mechanism, not mother, because mother is in control of father, not your control. So that could be a reason. So you do not need to write it anywhere in the examination, and do not, I'm just trying to tell you the logic behind it should be the control, because at that point of time, 1980s, 60 to 70% population of our country reside in village area. So there could be a problem, there could be a situation in which these three categories are generally under control of that individual due to dependency, you can say. Okay, so you do not need to write it anywhere in the examination. This is just to tell you the concept of this thing. Okay. So is there any query, students? So I guess ma'am is here. Simple ma'am, are you there?
Yes, sir.
So ma'am, please can you continue?
Yeah, sure.
I need to take leave. Students, all the best. Thank you so much, ma'am.
No problem, sir. I'll continue, sir. Yes, students. So, sir has completed this chapter, your clubbing provisions. These are very interesting chapter. Sir has beautifully explained you the intent. Yes, sir is rightly told you don't need to write in your answer. Sir is just trying to explain you what is the purpose behind introduction of this chapter, these provisions. And these are very old provisions, so don't think in the current scenario ki why son's wife or the spouse is under the control of the individual. It's not in the current situation. It's way back old when these provisions were initially introduced. So this was just to give you a brief that why it has been introduced in the Income Tax Act. Good evening. Yes. So student, do you have any doubt for the any provisions, or should I start with the MCQ just for your testing ki how much you understood from this session so far? In any provision, anything? Section 65, yes, Chauhan, section 65 regarding the HUF. I guess you are asking, if I'm not wrong, you are asking about HUF provisions? 65, it's a 64.2 is the HUF. 65, it's a tax liability. Who has to pay tax in case of the person is unable to pay? So section 65 is not in your syllabus. It's up to 64, subsection 2, and subsection 2 HUF is also to a very limited extent, which has sir is taught you in the class. Okay, Pooja, ठीक है, I am starting the MCQ. You have to give the correct answer based on the provisions which has sir taught you, and you have to give the reasoning also why it is the correct answer. So I am just sharing my screen. So yes, students, your first MCQ. There is a person, Mr. Ram, who owns 500 debenture of R Industries Limited or 500 each. Annual interest is 37,500, which is payable on this debenture in your current previous year, which is 24-25. He transfer interest income to his friend, Mr. Sham, without transferring the ownership of these debentures. While filing return of income of this year, Sham is who? Sham, the friend. He showed 37,500 as his income from debenture. So you are the tax advisor of Mr. Sham. So what Mr. Sham has done by showing his return of income 37,500, is it correct or not? This is the question. Just see, don't see the option first. Just try to apply the provisions which you have read so far. Frame the answer in your mind, then see what MCQ, in which option the MCQ, in which option the provisions is there. First, try to apply the provisions. Don't directly jump to the options. What are the options and which is, seeming right to you. Just click on that. Just try to understand and apply the provisions in it. I got one answer. Okay, some are saying B, some are saying A. Anybody C or D? Rajveer, you are giving which answer that is not justifying with the reasoning. Just check the option which you have given. Okay, Anil is saying, okay. Anil, would you like to give the reasoning? Just unmute yourself and give the reason why it's A.
Good evening, ma'am.
Good evening.
Actually, the ownership is not yet transferred. He just transferred the interest income. So as per my knowledge,
so what is the correct answer?
A would be the correct answer.
But your reasoning is very, very correct, because Ram has not transferred the debenture. He has only transferred the interest. Then why clubbing provision will be attracted?
Okay, sorry, ma'am.
The clubbing provision will not be attracted according to your reasoning also.
Yeah, ma'am, got it.
So in the first option, it's about Sham, whether Sham has done correctly by showing 37,500 as his income. No.
Yes.
It is not clubbed in the hands of Sham, because Ram has only transferred the interest. So it will be taxable in the hands of Mr. Ram only, in whose name debentures are, because he has not transferred the debenture, right?
Yes, ma'am.
Is it clear,
Thank you,
student? Harshda, do you want to unmute yourself and just tell me the reason? Because you have, everybody has gave the option A or B. You gave the option D.
Hello?
Yes.
Ma'am, actually, I feel because its debenture has not been transferred to Sham, right? So ownership is with Mr. Ram only.
Yes.
So it's the income in the hands of Sham, but it's not from the debentures because it's not pertains to him. Like it's a ownership is not with Sham, so he can't show that it's a debenture interest from. But we can show that he has received income or money from Ram, but he can't show that it's from debentures. I feel like.
Okay. Just try to understand this, students. There are two things. First is regarding the about the interest, ki whose hand this interest will be taxable. Okay. In this case, two things are there. Harshada very well, she has explained this, but only minute thing provision she has just ignored it. First things regarding the debenture interest. Debenture, Ram has owned the debenture, he has not transferred the debenture, so definitely the interest income, which is 37,500, it is taxable in the hands of Ram only. It will not be taxable as a debenture interest in the hands of Sham. Is it clear to everyone? Is this clear to everyone? It is taxable in the hands of Ram only? Yes. But Ram has transferred some money to Mr. Sham without any consideration. So what is just click in your mind? If one individual, one person has transferred sum of money without consideration to any other person, then which section just come in your mind? We have to check the applicability of that section also. Sum of money without consideration. No. Tanisha, section 60 is regarding the clubbing provision, and we have understood that debenture is taxable in the hands of Ram only because he has not transferred the debenture. Yes, Pooja, regarding gift, 56 to 10. When a person transfer any sum of money, immovable property or property without consideration or with inadequate consideration to other person, then section 56 to 10 is attracted. But in case of a sum of money, what is the condition? That the amount should exceed what? 50,000. But in case it is only 37,500. So it means section 56 to 10 will not be attracted. So we have to test that also, but it is not attracted. So that's why D option is incorrect. Ki Sham has to show the interest as interest income and not as the interest earned from debenture. Because in case of Sham, 56 to 10 is not attracted. But in the hands of Ram, he has earned the debenture interest and he has to pay tax on the debenture interest. Got it, student? So I'm just moving to the next MCQ. So in this, there is a person, Mr. Arvind, who has gifted a house property to his wife, whose name is Mrs. Meena, and a flat to his daughter-in-law, Mrs. Sita. Both properties were let out. Which of the following statement is correct? In MCQ A, Prakash, the correct option is option A. Option B. Ki no, since Ram has not transferred debenture to Sham, interest income on debenture is not taxable in the income of Mr. Sham. It will be included in the hands of Mr. Ram. And since clubbing provision is not attracted to Sham ke hand pe, nothing is taxable in this case. Got it, Prakash? So, is it clear? Yes, you can say yes. It's an application of income. When you earn some income, whatever way you have expended that income, that doesn't matter. For in the first instant, that income is going to be taxed in your hand. But if you are gifted to somebody, then you have to see the taxability in the hands of other person also. But under section 56 to 10. That we have dealt, it is not taxable in the hands of Mr. Sham under 56 to 10, but that doesn't mean that Mr. Ram will get an exemption of this interest debenture because he has not transferred the debenture, so he is only the owner of the debenture and interest income will be taxable only in the hands of his hand, and by whatever means he expended, that doesn't matter. Income will be taxable in the hands of the person who has the ownership. So we are moving to the second MCQ. So there's a person, Mr. Arvind, he has transferred one property to wife, one property to daughter-in-law. So you have, and both the properties are let out. So you have to see which of the four statement, which is the correct statement. Isham has already answered. Income from both properties is to be included in the hands of Mr. Arvind by virtue of section 64, yani ki by virtue of clubbing provisions. Income from property gifted to wife alone is to be included in the hands of Mr. Arvind by virtue of section 64. Mr. Arvind is the deemed owner of the house property gifted to wife and daughter-in-law. Mr. Arvind is a deemed owner of the property gifted to wife, and for the income from property gifted to daughter-in-law, that will be included in his hand by virtue of 64. So these are the four options. Again, I am getting a variety of answers. Okay. Tanisha, do you want to explain the reason behind your answer option C?
Yes, ma'am.
Yes, Tanisha. Why you have said answer option C?
Ma'am, because under section 64, we club income transfer to spouse, not a son's wife or an daughter-in-law.
But abhi to sir has explained na, there is a concept. Sir has explained na, son's wife ki there are in for three persons. One is spouse, one is your son's wife, which is daughter-in-law, and the second is minor child. For in case of transfer asset to any of three, then only clubbing provisions will be attracted. So in case of son's
Ma'am,
wife, clubbing provisions are attracted.
yes, but under section 64, I have noted only to transfer anything to wife only. I have not written under which section is applied to daughter-in-law, means son's wife.
I'm not getting your answer, Tanisha. Tanisha,
मैम मैं ये कहना चाहती हूँ कि मैंने ना नोट किया था कि जब सर हमें सिखा रहे थे कि अंडर सेक्शन 64 इज फॉर इनकम फ्रॉम एसेट ट्रांसफर टू द स्पाउस ओनली.
नहीं, but spouse के लिए there is a different section और son's wife के लिए there is a different section and minor child के लिए there is a different subsection.
यस, और एमसीक्यूज में उन्होंने सेक्शन मेंशन किया है और सी में सेक्शन मेंशन नहीं किया है, तो मिस्टर अरविंद ही डीम ओनर होंगे, बट
ठीक है, I will come to that also regarding your query. Shiv, do you want to explain your answer why A is the correct option? Okay, ठीक है, I'll explain. If you remember in your house property, income from house property, you must have read about section 27, right? What section 27 says? Section 27 says about the deemed ownership. These are two different things, student. One is about the deemed ownership. Ki if you have transferred the house property, still you will be treated as the owner of that house property. This is one thing. What 64 says? 64 says ki theek hai, you have transferred the asset, you are not the owner, but still income which is earned from that asset, that is going to be taxed in your hands. Theek hai, these are two different things. 27 says ki there are many conditions. One of the condition is that if you have transferred any property, any house property to your spouse without consideration, then you will be the deemed owner of that property. ठीक है, अब इस केस में Arvind has transferred his house property to his wife, to spouse, without any consideration. There is no question about consideration. So he will be the deemed owner of that property. But in that section 27, daughter-in-law or son's wife are not included under section 27. So, but daughter-in-law के लिए clubbing provisions are there under section 64. What this is, if you have transferred any property, any asset to your son's, to your daughter-in-law, to your son's wife, then whatever the income from that property is earned by the daughter-in-law, that will be clubbed in the hands of the person who has transferred the property. So you have to apply to different provisions. For a spouse, section 27 will be applicable, and for daughter-in-law, section 64 will be applicable. So the correct option would be option D, that Mr. Arvind is the deemed owner of the property which is gifted to Mrs. Meena, his wife, and income from the property which is gifted to daughter-in-law Sita, that will be clubbed by virtue of section 64. Is it clear? If that is clear, then I will just add something in this MCQ just to make it more clear to you. Up till that, is it clear? Okay. Suppose in this question, this is not a house property. This is any other asset. Suppose I am saying debenture. Mr. Arvind has gifted debenture to wife and debenture to daughter-in-law, and they are earning interest income from that debenture. Then what would be the correct option? Suppose read house property as debentures. Yes, very good, students. In that case, A will be the correct option, because section 27, which is deemed ownership, that is in respect of your house property only. That is not in respect of any other property. So when it comes to other property like debenture, shares or something, then still the income which is earned by the spouse, that will be clubbed in the hands of the person who has transferred to the another spouse. So in that case, daughter-in-law ke liye anyway clubbing provision will be applicable. Wife ke liye it will be under section 64, not under section 27. So A would be the correct option in that case. Okay, students? Moving to the third MCQ. Because as I told you, Dhanush, because in case of debentures, section 27 is not applicable. In case of section 27 is applicable only in respect of house property. Yes, daughter-in-law is not covered under section 27. Only spouse is covered and minor child, except minor married daughter. They are covered. Yes, Dhanush, I was just saying ki if you assume it is not a house property, it is a debenture, then I said that ki A would be the correct option in this case. But if you are reading is as a house property, then D is the correct option. So for this MCQ, D is the correct option. If we change house property to debenture, then A would be the correct option. Okay, Dhanush? So moving to the third MCQ, Pihu is a minor child. He gets a gift of 20 lakh from her father's friend. On the same day, the amount is invested as a FD in Pihu's bank account. On the said deposit, interest of 13,000 was earned during this year. In whose income this Pihu's income will be taxable? And you have to assume that mother of Miss Pihu or father of Miss Pihu or Pihu, all three are paying tax under the default tax regime, which is under section B8, 15B. Okay? So first option is that income of 20 lakh 11,500. How we arrived at 11,500? By giving the exemption of 1,500 under section 1032, because clubbing in case of minor child, then you will get an exemption up to 1,500. So income of 20 lakh 11,500 in the hands of Pihu's father, it will be taxable. Option B, without 1032. 20 lakh 13,000 in the hands of Pihu's father. Then third option, 20 lakh 11,500 in the hands of the parents whose income is higher. 20 lakh 13,000 in the hands of parents whose income is higher. I got answer from Ishan, Prakash, Tanisha. Okay, I got two different answers again. Student, clearly, just read the requirement of the question very clearly. In whose hand the income of Pihu shall be taxable, and also compute the amount of the income, and it shall be taxable under default tax regime. You have to be very clear about the default tax regime, because there are certain exemptions, certain deductions which are not permissible under the default tax regime. So don't do that mistake by ignoring that fact key. You have to compute under default tax regime. Yes, Pooja has corrected her answer. Section 10 की Section 10 exemptions, certain exemptions you can claim under 115 BAC, but 1032 की exemption you can't claim under section 115 BAC. So the correct answer would be D, income of 20 lakh 13,000, and it is not going to be taxed in the hands of father, because in case of minor child, whether father has transferred the property, whether father's friend or whosoever the person has transferred the amount, it would be taxable. You have to see whose income from the parents is higher. Suppose father is transferring the something to minor child, then it will not be taxable in the hands of father. It will be taxable in the hands of the parents whose income is higher. So in every case, in the case of minor child, it will be taxable in the hands of the parents whose income is higher, not the person who is transferred. ठीक है? Clear? D is the correct answer. 20 lakh plus 13,000, and there is no exemption of 1032 because default tax regime is there. Moving to the fourth MCQ, and इसके बाद also we have an interesting MCQ. Mrs. Bhavna, wife of Mr. Sonu, is a partner in a firm. Her capital contribution is 10 lakh to the firm as on 31st March 2024. In that date, 10 lakh includes 6 lakh, which is contributed out of gift which she received from Sonu. On 1st April 24, she again invested 2 lakh out of gift which is received from Sonu. So the firm has paid total interest of 1 lakh 20 and share of profit of 1 lakh. So we have to determine which statement is correct. This entire interest has been allowed as deduction in the hands of firm. So first option, share of profit is exempt, but interest on capital, wholesale interest is taxable in the hands of Bhavna. Share of profit is exempt, but you have to proportionate interest. 80 is in the hands of Sonu, 40 in the hands of Bhavna. Share of profit is exempt, but interest 72 in the hands of Sonu, 48 in the hands of Bhavna. Or share of profit to the extent of 60 and interest on capital to the extent of 72. That is included in the hands of Sonu and the remaining in the hands of Bhavna. Take your time, student, because you have to do the little bit calculation. Not so much, but little bit calculation is required in this question. So take your time. $10 lakh capital was there as on 31st March. Out of this, you have to draw 6 lakh is related to Sonu and 4 lakh is related to Bhavna. Then 2 lakh again is invested in the partnership firm, and that amount is gifted by the Sonu. So total contribution which is made by the Sonu in that firm is 6 plus 2, 8 lakh. So total capital as on 1st April 2024 is 12 lakh. Out of that, 8 lakh relates to Sonu's gift and the 4 lakh relates to Bhavna. Most of the part I have explained to you, student, already. You have to do the just calculation only. Got one answer? Anyone? Okay. Sorry. Priya, would you like to explain the reason? Yes, Priya?
Good evening, ma'am.
Good evening. Ma'am, this is regarding the the gift, the contribution which has been done by the husband as
Yes.
on the 1st April 2024, whatever amount has been invested by the husband, on that the proportionate profit will be taxed in the hands of Mr. Sonu only. So he invested 6 plus 2, 8 lakhs out of
12
the
lakh.
total 12 lakh. So the proportion of the profit, like 1 lakh, out of that 60,000, if we calculate, 60,000
ठीक है.
will be taxed of Mr. Sonu, and same in respect with the interest
But
on capital.
interest ka, if you do the proportionate interest ka, if I'm not wrong, 80 and 40 will be there, no?
Not
क्योंकि 8 is in the hands of Sonu, 4 is in the hands of Bhavna. The 2:1 is ratio is there.
Ma'am, it will be 6 divided by 10 into 1,20,000.
But you told 8, क्योंकि 6 is initially, then 2 further on 1st April she invested out of Sonu's gift. The total it's 8, na? 6,
But-
it was initially it was 6, then 2 furthermore she invested out of gift which is received from Sonu.
But that's after the, that's
Yeah,
on the
But that's on 1st April.
Yeah.
So if you are 1st April ko, you have to see the capital balance on 1st April. So 1st April ko she has invested.
Invested 2 lakhs, that won't be included. If we talk about the capital, that will be 6 lakh divided by 10 lakh into 1 lakh for the profit. That will be 60,000. And for the interest on capital, if we talk about, that will be 6 divided by 10 into 1,20,000.
Yeah, that is what I want to understand, Priya. Why you have done 6 divided by 10? That is my question only.
Ma'am, because it needs to be checked on the very first day of the previous year.
The first day
That,
of the previous year is the 1st April. 1st April ko to she has invested 2 lakh.
But I think that 2 lakh will be included for the next next
No, Priya. First day of the previous year, you have to check on the first day. It's not ki first day ki morning or first day ki evening. You have to check on the first day of the previous year, which is on 1st April. 1st April ko she invested 2 lakh.
Okay.
So its total capital will be 12 lakh. Out of that, 8 lakh would relate to Sonu and 4 lakh relate to Bhavna. So you have to proportionate between 80 and 40. So, 2:1 ratio. So interest will be 80,000 in the hands of Sonu, 40,000 in the hands of Bhavna. But one thing you have to understood, share of profit also you have bifurcated, but share of profit is exempt from the partnership firm. Do you remember in the PGBP, you must have taught this key under section 10(2)(a).
Yes, ma'am.
Yes, na? So where the clubbing provision is there, when something is exempt, then you don't need to apply the clubbing provision when something is exempt.
Right.
So regarding the profit part, it's completely exempt. Regarding the interest part, student, because she invested on the same day, on the 1st April. Suppose she received on 1st April and she invested in 2nd April. Then in that case, you will not consider this 2 lakh. But since she on 1st April itself, the capital was increased from 10 lakh to 12 lakh, you have to see the capital as 12 lakh and you have to bifurcate between Sonu and Bhavna.
Okay, so that means we have to include 2 lakhs also.
Yes, you have to include 2.
Okay, all right.
Okay. So, okay, students. So correct option is option B. Share of profit is exempt, but interest of 80,000 in the hands of Sonu and 40,000 in the hands of Bhavna. Clear? Yes. Ratio of 8:4, 2:1. Last MCQ, it's a very interesting MCQ because you have to apply multiple provisions here also. It's similar to this MCQ, but a little bit trick is there. Mr. Raj makes a gift of 25,000 to his wife, Mrs. Rama, on 27th March 2024. Mrs. Rama on 1st April invests rupees 75,000, 25,000 out of gift, which she received from Mr. Raj,
and 50,000 of her own in a partnership firm as a capital, which is a total capital contribution in the firm. She has not introduced any capital further or something. This is the total capital of Mrs. Rama, that is 75,000. During this year 24-25, she earned interest of 12,000 and salary of 1,20,000 from the firm. Both are approved by the partnership deed. So you have to tell what amount is to be included in the hands of Mr. Raj. There is a trick, student. I have already told you. So all the provisions which you know about the firm, then just it should be click in your mind ki, okay, these are the provisions related to firm, and any of the provision can be applied in this because there's a trick. Got one answer? Same answer by Ishan and Prakash. Janvi also gave the same answer. Julie Kumari, she has given a different answer. Firstly, I just in the meantime, I'll just give you the hint also. First of all, students, in case of salary from the partnership firm, clubbing provision is not attracted because salary is not for the capital contribution. Salary is always for the efforts which the partner has taken place. So if Mrs. Rama is the partner of the firm, she is getting the salary. She is getting her salary maybe because of the work she is doing in the firm, not because of her capital contribution in the firm. Capital contribution की वजह से you are getting the interest. You are not getting the salary for capital contribution. Yes. Okay, most of the answer I am getting the answer as B. Anyone different answer? ठीक है. A student just giving you hint. Anyone wants to explain what section 40B says about the interest on capital? Just raise your hand. What section 40B says about interest on capital? PGPP में you must have done 40B. There is certain limit ki how much interest is allowed in the hands of firm to the given to the partner. There is a remuneration condition also. So what is the condition for the interest on capital? Anyone? Yes, Pooja?
मैम अप टू 12% तक अलाउड होता है.
Yes. Under
In the hand of
PGPP. Yes, very good, Pooja. In case of in the hands of firm, only interest up to 12%. Whether the partnership deed has allowed 18%, 20%, or whatever the percentage, maximum 12% interest on capital is allowed in the hands of firm. And whatever the amount is allowed in the hands of firm, the same amount is going to be taxable in the hands of partner because otherwise double taxation will be there. So 75,000 pay if you compute, because total contribution, capital contribution by Rama is 75,000. If I'm saying maximum firm can get a deduction of 12%, then what the firm will get the deduction of? How much amount the firm is getting the deduction for this interest on capital? 9,000. Because firm has paid 12,000, okay, but because her contribution is 75,000 only, so firm can pay the extra amount, but only up to 12% of the capital. Firm can claim the deduction as interest on capital, and the same amount that is going to be taxed in the hands of partner. So 9,000, firm has claimed a deduction for the 9,000. So 9,000 is going to be taxed in the hands of the partner. For 9,000 amounts, you have to do the proportionate between Raj and Rama, not for the 12,000, because 3,000 की deduction तो firm को ही नहीं मिली. Got it, student? If you see, there's a firm, there is a partner. Firm को जो भी deduction मिली, that is going to be taxable in the hands of the partner. ठीक है? Firm ने claim करा whatever the interest on capital, that is taxable in the hands of partner. Firm को जितनी भी मिली for the remuneration, that is going to be taxable in the hands of the partner. When firm is only getting the deduction for interest on capital of 9,000, then 9,000 is going to be taxable in the hands of partner. So 9,000 is going to be taxable in the hands of the partner, Rama. Then this 9,000 we have to proportionate between the Raj and Rama, because Raj has gifted some amount which she contributed in the firm. So which is 25,000 related to the gift and 50,000 of her own. So it means 25:50. It means 1:2. So 9,000 you have to proportionate between 1:2. So 3,000 as interest on capital from firm is going to be clubbed in the hands of Mr. Raj, not 4,000. Clear, student? Ma'am, in the first question, since the income is taxable in the hands of Mr. Ram only, so ma'am, it means that clubbing provision would apply, no? Yeah, I'm not getting this, because in the first question, debenture has not been transferred, only interest is transferred. So for clubbing provision, asset must be transferred. So that's why interest is taxable in the hands of Mr. Ram. In the hands of Mr. Sham, it can be taxable under section 56(2)(10) because it's not a relative or it is not falling under any exception. But since the amount is less than 50,000, 56(2)(10) is also not applicable. Clear? This fifth MCQ is clear regarding the 40B also. Prakash, 56(2)(10) applicable kisme you are saying about? In first MCQ? First, I told you the 56(2)(10) will be applicable if the interest amount is more than 50,000. If suppose the interest on debenture is suppose 60,000 or 70,000, then it will be taxable in both hands. Mr. Ram also as interest on debenture and Mr. Sham also as income from other sources as sum of money received without consideration from a friend. Okay, I'll explain the first MCQ again. Because student multiple, at the time of one question, it's not like it's question related to one provision also. You have to apply all the provisions of the income tax. That question is an integrated question. It relates to many provisions. Like in the second MCQ, section 27 also that is in the picture. So in this 56(2)(10) is also there. Yes. Suppose I'm saying in this, just ignore the option. I'm not just going to the option, just this is the facts of the question. In this case, it is going to be taxable in the hands of Mr. Ram because Ram has transferred the debenture, not transferred the debenture, Ram has transferred the income only, and which is application of income. Because he has not transferred the asset, he has the ownership of the asset. So that's why section 60 will apply and interest on debenture will be taxable in the hands of Mr. Ram. This is the one thing. Is this clear to everybody? Section 60 is there and he has not transferred the asset. So there is a no clubbing. Is it clear? Up to that it is clear? Yes. Now we have to see the taxability in the hands of Mr. Sham. Mr. Sham doesn't own the debenture. So clubbing provision was not attracted, nothing is there. But we know there is a section 56(2)(10) which says that if any sum of money you receive from a known relative or unless otherwise it's an exception category, then it is going to be taxed if it is more than 50,000. But in this case, it's 37,500. So 56(2)(10) is not attracted. So nothing is taxable in the hands of Sham. Is it clear? Pooja, 56(2)(10) is not applicable in the case of spouse. 56(2)(10) mein there is a relative, many relatives are there, your wife, your spouse, your son, your daughter-in-law, spouse of the individual, many things are there, and in that case, clubbing is not attracted. So 25,000 ka, which we are saying in the last MCQ related to capital contribution, in the hands of the transfer of any amount, any money, any property to your spouse, 56,210 doesn't attract. Yes, Tej, correctly. If this amount is more than 50,000, double taxation will be there. 56,210 is only because of that, no? Definitely it is there. If you see student 50C, when you compare 50C, 56,210, 50C, what it says, when your stamp duty value exceed 110% of your sale consideration, then you have to take the sale consideration, your stamp duty value. Similarly, in the 56,210 also, when the difference exceed 10% of the your difference exceed 10% of your consideration of your 50,000. If it exceed, then it is going to be taxed under 56,210. Then in that case also double taxation is there, because in the hands of the transferor, you are taking stamp duty value, not actual sale consideration, and that difference amount you are taxing in the hands of the transferee also. So in that case also double taxation is there. So when a person try to evade the tax, then definitely double taxation arises. Yes, application, if you are doing the application of income, then it is taxable. Diversion of income, then it is not taxable. Correct. So is it clear? Pooja wants to say something. Yes, Pooja?
Ma'am,
Yes.
in this case, matlab, MCQ number 5, why 56,210 will not be applicable, ma'am? Because it is given to his wife, and wife is relative. So 25,000 would not be taxable, because
two things are there. First thing is there's a limit of 50,000. Okay. Second thing, we don't need to go to the limit, because when you transfer some, give sum of money or property or gift any amount to your spouse, then 56,210 doesn't apply.
Ma'am, relative definition, matlab, in 56,210 relative or HUF, there are some exemptions, ma'am, in which it is given that if anything transferred to relative, then it is exempt.
हाँ, तो wife is a relative, no?
Yes, ma'am. So 25,000 would be exempt.
हाँ, तो 25,000, nobody has taxed 25,000. When I said that 25,000 is a taxable.
Yes, ma'am. I was saying that.
No, 25,000 is not taxable. It is clear. 25,000 is not taxable.
I was saying that only, ma'am.
No, you are very right. You are very right. 56,210 is not attracted, and nothing is taxable in the hands of Rama, because she has received from her husband. So 25,000 is not going to be taxed.
Yes, ma'am. Thank you, ma'am.
Okay. Ishan, application of income, when you have the right on the income and then you are applying to some income. So you are the ultimate, you can say you are the ultimate benefit. You can take the benefit of that income, but you are not taking the benefit, or you are apply or giving to someone, but instead you can take the benefit and you can anytime stop that stop that benefit given to the other person. That is your application of income. But diversion of income means ki by some law or some order of court, you don't have the right on that income. When the income arises, you have to definitely, by some law or by some order of court, you have to give that amount to some other person. You don't have any right, or you can't claim any right on that income. That is called diversion of income. Applications means there is nothing by law or by order of court, or there is nothing. You are just out of your affection of love, you are just giving to somebody. There is not obligation on you to give that to some other person. When it is about the obligation, then it's a diversion of income, that you are obliged by some law or some order of court that you have to give that amount to some other person. Then it is a diversion of income. So in that case, diversion के case में, that income first hands pay, you are not the owner of that income, so it is not going to be taxed in your hands. Suppose you have received 5,000, there is some order of the court that you have to give this 1,000 to some other person XYZ. then only 4,000 is going to be taxed because you are not the owner of that 1,000. That 1,000 is going to be taxed in the hands of other person who is receiving that. Clear, student? Just keep your queries. If you have any other query, just take the practice of this chapter. Still, if you have any query, because test your knowledge question sir has given you as a homework. So if you have any query for this chapter also or something related to that provision, we will take into the next class. Okay? Just do practice because in the next class, set of carry forward provisions will be started. So initially, sir will explain you the test of knowledge question, but do practice. Okay, students. No, Anil, diversion, that doesn't mean that assessee is trying to divert to avoid tax. When you are mandatory, you have to buy certain laws and order of court. You have to give the amount to someone. That is not a diversion. Why court will allow you to divert your income to avoid tax? Application of income, it means you are trying to avoid the tax. But law says that no, if you are trying to give money to someone just to, don't get a tax in your hands, then we will not allow this and it is going to be taxed in your hands only. But diversion means that you have an obligation. You don't have that right on that income. You have the obligation to give it to someone. Then in that case, you are not trying to avoid the tax. Okay, students. So this is it with this session. Thank you very much. Okay, good night, students. Yes.